Welcome to the Small Cap Virtual Investor Showcase. My name is Steve Torsa. I'm the founder and managing director of Wholesale Investor. WI has had the opportunity to work with many small cap listed companies over the last few years that have gone on to become absolute stars. In 2020 alone, 8 small caps that we worked with experienced over 100% increase in share price since being featured. Now, we all know that with small caps, timing is everything. And we would like to give you now access to some emerging small cap opportunities that are in sectors that are currently being really in strong demand from their financial marketplace. Now, these companies cover IPO and also small caps, and we want to give you direct access to hear from the CEOs. Today's companies presenting include Predictive Discovery, Telix Pharmaceuticals, which has had an incredible run over the last few years, Image Resources, Calima Energy, which in the last few weeks also saw a significant boost in their share price, Pioneer Credit, Banxa. This year, they listed on the Canadian Stock Exchange and have had an incredible run going from $1 to anywhere between $4 to $8 in their share price. Now, we've been fortunate enough to work with Banxa since they were a seed stage companies. White Rock Minerals, Altech Chemicals, another company we've worked with over the last few years where the sector influence is really now coming into timing for them. And then Ensysce Biosciences. As keynote speakers, today we have Tim Fung, the co-founder and CEO of Airtasker, and obviously they also made their debut on the ASX this year, but have been a highlight for the startup ecosystem as far as what is possible for Australian tech companies that are now taking on a global marketplace. And James Graham, the CEO of Recce Pharmaceuticals, who's targeting an important area identified by the World Health Organization with antibiotic-resistant superbugs, and they've got their own solution for that area, and I'll obviously let him talk about that more. Now, you're also going to have a panel session where we get to discuss one of the biggest topics in the marketplace for 2021, which is momentum investing versus value investing. Which one wins 2021? Our panelists for this session include Ron Shamgar, the head of Australian Equities at Tamim Asset Management, John Diddams, who's a principal and non-executive director of many ASX-listed companies, Lelde Smits, who's the founder of the Capital Network, and Justus, who's the CEO of Paws, who is also another company that we worked with from their early stage, and we've now gone on to see them successfully list on the ASX. And then Rod Hay, who's the head of distribution and investor relations at Collins Street Asset Management. Now, we know the importance of a simplified and streamlined process for you. So all the companies being featured today, they do have information inside their Chris deal room. Now, obviously being listed companies, we're sure you've probably got your trading terminal also up in front of you as well. So everything today, we really just want to give you easy access to information. So whether you've got your trading platform up in front of you or you've got Crisp up in front of you, either way, it's a simplified way for you to access documentation, information, latest news, etc. Once again, I welcome you to the Small Cap Virtual Investor Showcase. I hope you enjoy the event and look forward to joining you at the conclusion.
Our first keynote speaker today is Tim Fung, the co-founder and CEO of Airtasker. Tim will be discussing his learnings from international expansion and scaling, as well as exponential business models and the secret of growth.
So for today's interview for the Small Cap Showcase, I'm very proud and happy to welcome Tim Fung, who's the CEO of Airtasker, who this year recently debuted on the ASX. And for me as a founder, watching these journeys sort of since 2012 and sort of first coming across the company and then watching their growth and their rise and obviously expansion into international sort of locations, it's been an inspiring story to watch, and it's fantastic to have Tim on as part of the sort of keynote interview today. Welcome, Tim.
Thanks for having me, Steve.
So, mate, obviously big year, big last sort of 12 months for you. What's been that journey for you going from being a private company to now a listed company, and obviously the fanfare and the attention that you received as part of that?
Well, the last 12 months have been really, really an interesting journey, a couple of ups and downs. I reflect back to the beginning of 2020, COVID was, the talk of, the impact that would have on our business. We saw a depression in marketplace volume initially, but then saw that the whole community of taskers and customers really adapted to the situation, and because of our infinitely horizontal marketplace, it actually had a V-shaped recovery and actually ended up being our biggest year in terms of point-to-point growth. Towards the end of the year, we decided to move into becoming a public company. So we spent the next 4 or 5 months up until the 23rd of March working on an IPO. And it was a real journey to be able to do that whilst at the same time keeping all of our growth initiatives still rolling forward. Then since being a public company, look, I think the main difference that we've noticed is that there is a lot more time boundaries when you're listed. You've got quarterly cash flow statements, you've got half-yearly reports and half-yearly results to hit, and then of course full-year results to hit too. And so you've got this sort of forced cadence and this forced level of accountability on a quarterly, half-yearly, and annual basis. And actually, I think for a startup, that's actually potentially really healthy levels of discipline to have that cadence in place. So look, we're only about 6 weeks into it right now. We have done our first quarterly report, but so far so good.
I was going to say, I did notice in that report or some of the announcement you put out, you are expecting to exceed what you've put out in your prospectus, which is always a nice indication to put out.
So we upgraded our prospectus forecast from $143 million in GMV up to 148 to 152. So a healthy upgrade, and we're seeing things work out really well so far in 2021 calendar year. So it was great to be able to put up that prospectus upgrade.
Now, that's obviously some of the details behind it. Now, let's go back to the story of Airtasker, right? Just in case, someone's been living under a rock and hasn't come across you beforehand. It'd be good to give a bit of a background as far as the origins of Airtasker, and also, like for me, and afterwards I'll sort of ask about this, is who are the taskers, who are the users of it, and just really help sort of identify that.
Well, Airtasker started back in 2011, so it's been almost a 10-year journey for me so far. We had the idea when I was moving apartments, and I asked a friend to help me move. He has a truck that he uses to do deliveries for his frozen chicken nuggets business. So we put all the stuff in the back of the truck, and he helped me move. But this just got us thinking: is like, why do we ask friends and family to do all these kinds of jobs? And what we realized is there's just no real fit-for-purpose way to connect with local services or to connect with people in your local community who can help with these kinds of tasks. And it's kind of crazy because if you look at how far we've come in terms of buying and selling physical products, we've gone from market bazaars all the way through now to this elite e-commerce that happens 3-hour delivery, next day delivery of any item you want straight to your door. And yet the way that people connect with local services is still to, roll the dice and find the first person they find on Gumtree, or ask their cousin for a recommendation or something. And it's kind of crazy. So what Airtasker is doing is we're making a simple e-commerce for local services. And at the same time, we're creating jobs and income for people in our community. And that's really our mission at the heart of Airtasker, is to create jobs, income, and a positive impact on the future of work.
And especially given that last 12 months, it's such a powerful mission to have. And the other thing I really love about how you built into the platform, and I suppose this comes with the territory of e-commerce, is the trust. You mentioned it before, is that typically people just get a recommendation from someone and just roll the dice, right? As you said. But you build in these trust and confidence indicators for anyone looking to do it. And that's really, like, as a fundamental power that sort of sits behind the user experience, I found that personally important in sort of using Airtasker.
That's right. So one of our marketplace principles at Airtasker is that we create trust through transparency and accountability. So rather than us coming in and managing and handling tasks and telling people what to do and micromanaging, what we're saying is we believe that people are fundamentally good and can be trusted. We're going to create a transparent system so you can see all of that information. And then we're going to make sure that our taskers are accountable at each step of the transaction, and our customers are accountable too. And we do that through by owning the end-to-end transaction that goes through the marketplace. And that basically makes sure that we've got a record of what's happening at each step. And that's what keeps Airtasker accountable. So yeah, really, instead of creating trust through by nudging things and micromanaging. We're creating trust through transparency and accountability.
Love it. And what have you observed as far as the demographics of, firstly, the taskers, the people obviously fulfilling the jobs? What have you noticed as far as their demographics?
Well, one of the biggest challenges of Airtasker is that we are an infinitely horizontal marketplace. We offer all kinds of services, whether it's from things like cleaning and gardening and handyman jobs, all the way through to surveying and architecture and tax consultancy. And so you've got this really wide breadth of users on our platform. And whilst that is fantastic, we've got this massive total addressable market, it's also challenging because interpreting the data is even more difficult when it's so wide and so unstructured. So when we zoom in a little there, what we have noticed is that we are more of an urban focused company compared to regional areas. So that's really where it's started to really to grow out. Although we're now starting to see regional areas like Newcastle and Wollongong build sizable communities as well. And then within that, on the customer side of the marketplace, the demand side, primarily we're targeting young families and young professionals. And then on the tasker side of the market, there are roughly three groups. We've got students and younger folks who are looking for a flexible style of work. We have freelancers and professionals, so people who have developed skills like graphic designers, gardeners, tax consultants, etc. In that freelance professionals space. And then we have our semi-retiree bracket. So we've got a lot of folks who are in that sort of 55, 60 plus age group who might not suit them to want to work in permanent full-time jobs, but absolutely they're staying active, earning an income, and helping people out and sharing their experience in the local community.
And as you mentioned, like I said, what I love about your business, and I said I admire from a founder to another founder, is you do have those infinite amount of verticals. And the reality is there's verticals that don't even exist today that you could be monetizing sort of 2 to 3 years from now. And so I'm just curious, like, how do you discover those trends? As you said, given it is so wide, how do you discover those trends, and how do you sort of place focus on areas which you see a great opportunity for you to get additional growth or scaling potential, etc.?
It's a great question. So Airtasker is, as you mentioned, an infinitely horizontal marketplace. Really, we allow our customers to be able to present any problem that they need solved, by humans with skills. And we empower our taskers to be able to solve those problems in any way that they see fit. One of the fantastic things about this marketplace model is that it's our customers who every single day are telling us what the next trend is. And so actually, I think COVID was a great example of this. During COVID, domestic cleaning demand dropped massively because people were at home, they were working from home, and they didn't need a cleaner coming into their home to clean up. But what we saw is that remote fitness instructors spiked massively. Bicycle repairs spiked massively, and people started doing a lot of like home repairs and renovations and things like this. So the marketplace just sort of adapted, and we got told by our customers what the next trends were, what they were demanding. And so having a demand-powered marketplace is really exciting in that regard. The way now that we're actually turbocharging that and taking that to the next level is that we've created a new marketplace model called Airtasker Listings. And what Airtasker Listings enables is our taskers to be able to create predefined packages of services at fixed prices. And they can then put that on the shelves of the Airtasker store. So when you open up our app, you can see all of the different packages that are available. And from that, we're learning even more now about what our taskers' skills are. And we're seeing which of those skills gets real uptake from our customers. And so that's another great source of learning about what the next trends are.
That actually leads to next question quite perfectly. Like, that's obviously a new product, right? So what I would love to know is, what is your product creation model? What is the thinking process? Where does it start from the team members? And then from the, let's say, from the observation in trends through to the ideation, right through to the execution. What does that look like for you?
So I think, first of all, a really interesting clarification here is that when you say what is the product of Airtasker, one thing that we're constantly reminding ourselves of is the product of Airtasker is the marketplace. And so the product isn't just the software that we build, the apps and the website that we've crafted, or the database and the tables. It's actually also about the people in the community and the culture that you're building within that community. So Airtasker, the product, is actually the software plus the community and the people. And so we can't do it on our own. We don't craft the whole product. We actually rely and engage with our community to be able to do that. So in thinking about that, we have a combination. So some things at Airtasker are certainly strategic initiatives that come from the top down and are based on our vision. And so we have a 3-year vision. We cascade that down into strategy. We then cascade that strategy down into areas of investment, which we're willing to explore and to allocate capital to. We then go to the experts in our team, which is what we call the product leadership team. So these are the folks that are overseeing each of the cross-functional teams that we have at Airtasker. They take those areas of investment and they go out and do the deep dive exploration of, is this actually possible? Is these goals that have been set realistic? And they really firm out the plan, and that manifests ultimately into OKRs, which is the framework that we use, objectives and key results, for those who aren't familiar with that. From there, it's really our leadership team that holds those teams accountable and guide them along the way as they autonomously go out and try to achieve those objectives and key results. This is definitely something that is constantly evolving at Airtasker. Like, how do you provide that blend of strategic vision compared with autonomy and empowering the people who are close to the ground and closest to the customers? And I think that it's fair to say that we're still figuring out how to get that perfect blend of top-down versus bottoms-up planning.
Gotcha. And also what's obviously quite unique about you is there's obviously a lot of sort of local market sort of online platforms, but they typically specialize in different verticals. Now, I find it interesting that you weren't the first sort of local marketplace or local services marketplace to launch, but you've obviously become the leading in that time. What do you think is the real sort of differentiator for you that's been able to allow you to do that?
One of the contrarian philosophies that I believe we have at Airtasker is, and there are a couple, we're a kind of contrarian thinking company, but one of the contrarian thoughts, I think, is this idea of the long tail of services. So one of the analogies that I use is the difference between television in 2005 versus YouTube. And so back in 2005, this is just before YouTube had started, the example that I've used is that ABC Studios in the US had Grey's Anatomy, and it was generating tons of money in advertising dollars for them. And I think they quoted something like 20 million people, tuned in at every episode of Grey's Anatomy. And they sort of thought, this is where we're on the top of the world. It doesn't get much better than owning Grey's Anatomy. At the same time, on the other side of the US, YouTube was getting built. And the first video on YouTube was some guy at the zoo just going, "Hello, I'm at the zoo." And that was the whole video. And obviously, if you were the ABC exec looking at that, you'd be like, that doesn't stand a chance against Grey's Anatomy. But what I think they missed is that the summation of the inspiration of all these individual people creating all these small videos was absolutely massive. It's not just a guy at the zoo. It's also an unpacking video, a reaction video, a video about investing on the stock market. All of this summation of these ideas was so large. And so if you bring that back to Airtasker, right now, you can hire a plumber or a renovator to do certain types of work for you. And that is certainly a big industry, that big existing industry. But there's also all these like latent skills that people have, whether it's, folding origami cranes, being able to, translate a document from Japanese to Hebrew, whether it's being a comedian who can come and perform at your weekend birthday party, all of these like latent skills. And we believe that the aggregation of all of those long tail of opportunities that come from these skills is massive. And I think what we're starting to see that play out on Airtasker, where it's all of these things that you can't get anywhere else that you can get on Airtasker, actually sums up to quite a sizable marketplace.
And it really is what makes you special. I said it's so surprising when you go and you see the range of different services that are available for people to perform. Now, the other thing that I find interesting is a few years ago, you basically embarked on heading to the UK. How was that experience for you as far as expanding your company from Australia to the UK? How was that? What did you notice was differences in the two markets? And as from a growth rate perspective, how did that really start to, and given the size of the population of the UK, how did that really start to change the dynamics of your revenue and your growth?
So the UK has been a great learning opportunity for us so far, and we have a huge amount of aspiration for that market. So I'm telling the story like right from the beginning. So we actually launched into the UK back in 2018. We spent quite a few $1 million over the course of 18 months or so, 2018. And what we proved during that time is that we could proactively set up a team and create that 0 to 1 in the marketplace very, very quickly. In fact, we achieved the liquidity levels that we had in Australia, 3-4 years in. We did that in about 12 months in the UK. So we had millions of dollars of GMV already going through the marketplace by that time. Then what we realized is that if we really want to scale this thing big time, then we don't want to be spending millions of dollars every single time we do that. We were quite inefficient in the way that we built it. So we actually spent the next sort of 18 months after that actually figuring out how to make this machine much more efficient. And so we've converted most of our growth over there from paid performance marketing to more organic marketing through things like SEO and PR and social. And actually, now the UK market is actually already cash flow profitable for us and is still doing millions of dollars of GMV and on that solid trajectory. And now that we've got that, really solid kernel of a marketplace, we're now going to start scaling that model into new international markets. So we've more recently launched into Ireland, Singapore, New Zealand, and the US. And really, I think that it's a matter of timing. It would not have been a good idea to have tried to scale that inefficient model that we did the first time in the UK. We want to make sure that we're scaling something that's really, really efficient. And so we want to take our time in doing that. We don't want to blitz scale the marketplace and just spend like absolutely crazy. We're now operating cash flow positive. That's really important to us to operate in a space like that. Cognizant that we have to invest into new markets, but not doing it in that crazy way. We want to do it in an efficient and responsible way.
And give some insights into how you've actually structured the business to scale, how can I say it, without putting massive resources into the sales side, into the marketing aspect. And I think the other thing you identified is more sort of some of the manual tasks. So give some insights into that, because to me, looking at your business model, that is one of the most powerful aspects I see, is that you do have an ability to infinitely scale across many different verticals, and you don't have a requirement to do that with sales teams, as most sort of as many businesses do.
Yeah, it's a great insight. So if you look at the Airtasker model, I think one of the things that we're most proud of is that we've able to build up a gross margin of around 93% on our revenue. And the reason why we can do that is because we really think about the marketplace that we've built as a machine. And in this machine, we don't want to have to keep fueling it with direct marketing, paying lots of money to acquire customers. We don't want to have like a big sales team that are onboarding people and handling there. We certainly don't want to have a manual handling in the system of individual tasks. That would just not be part of the model. And so the way that we really think about it is all about creating marketplace models that reduce friction in our marketplace, so allow things to happen easily. But then also making sure the incentives of everyone in our platform are aligned to wanting the same thing. So you'll notice that, for example, in our fee structure, the way Airtasker earns its revenue, we only recognize revenue when a task is actually completed and a tasker actually receives income. And that means that Airtasker, the customer, and the tasker all wants the exact same thing, which is the job done to the satisfaction of all parties. So by creating that sort of machine that can, produce these task outcomes, we don't need to have all of these sales folks, as you mentioned, or all these operational staff. And actually, as we scale into new countries, one of our core theses is that the majority of the investment, the capital allocation that's being made, is actually being made towards teams that are based in Australia, but that are activating markets that are in international geographies. And we are very confident that this model works because actually at Airtasker in Sydney, no one's actually stepped out of Sydney. Like there's never been a team on the ground in Melbourne, Brisbane, Adelaide or Perth. And in fact, Melbourne is a larger marketplace than Sydney, even though we have never had a person on the ground in any of those markets. So as we scale into these new international markets, we're doing a similar model. We are localizing what needs to be localized. So for example, press relations, public relations is something that we think is important to have localized on the ground. Content creation is something that we believe is local. You know, you want to create content that is relevant to Americans. You should have that person in that market and in fact in that city. But the majority of our team are product, software, and engineering teams that are based here in Sydney and dedicated to each of those markets.
Incredible. I think that's like probably one of the best lessons that any founder and any investor can take away as far as looking for businesses with growth models that have that obviously exponential potential, because obviously software is between software and marketplaces, there is infinite potential that can be created. And as a final question I have is that for you, when you're thinking about Airtasker, you mentioned you're 10 years old this year. When you're thinking about the next 5 years, like what's the vision you see for Airtasker over the next 5 years?
Airtasker's vision is to empower people to realize the full value of their skills, and we believe that this is a global problem and it's a globally relevant mission, especially given the recent pandemic and the impact that's had on the economy. So, roughly, I see that there are three main areas that help us to work towards that mission. Firstly, is the sphere that we're in right now, which is creating more working opportunities. And we are really laser focused right now on create more work opportunities. The way that we do that is to be the go-to place for local services. Just make it really easy for people to buy local services because that means more jobs. So we're all about this idea right now and just focusing on work. But I think there are two spheres that sit on either side of that. One is working on how to help people create new skills. So I think there you've got things like education and helping people sort of come into that marketplace with more skills. The more skills that we bring into our marketplace, the more that we can create more jobs, and that really helps to power us towards our mission. What comes out the other side of being able to turn your skills into income is, of course, financial, is money and income. And we think there's a great opportunity to help people and empower them in that sphere as well. So with things like financial services and helping people be able to be in traditionally what has been a tough category for financial services to help out in, the freelance economy and the flex economy, other than full-time jobs. We think there's a huge opportunity there. So roughly speaking, I'd say it's work, it's skills development, and then it's helping people to manage their income and make the most of what they're earning through Airtasker.
And is there any markets which you can that you really think about for the next 5 years would be important for you to move into? I mean, international markets, that is.
For sure. So we are pretty laser focused at the moment on the UK and the US markets as our higher priority markets. And that gives us exposure to a total addressable market of around 500 million people and about $600 billion in local services TAM. And that TAM is actually fairly conservative in that it's actually built based on what people are already spending on local services, as opposed to what the unlock could be through something like Airtasker. So right now we're really focused on those two markets, but of course, as we seem to hit each sort of step of the way, our ambitions tend to widen. But I think 500 million people is enough on our plate at the moment.
Well, Tim, thank you so much for your time today. I really appreciate it. As I said, from founder to another founder, absolutely inspired by your story and what you've been able to achieve in that time. From an investor's perspective, I said you look at that, you look at your model, and obviously the margins that you mentioned, the potential across all the different sort of segments that you've got the ability to go into, and then also the international potential that goes along with it. It's an exciting opportunity, and obviously proud to from an Australian perspective, and it's always good to see Australian companies doing well in overseas markets.
Steve, thanks for having me.
Thanks, Tim.
Presenting now is Pioneer Credit, an ASX-listed company specialising in the acquisition of impaired or non-performing debt portfolios from various vendors. Here to talk further about this opportunity is Managing Director Keith John.
Good morning, and welcome to Pioneer Credit's presentation for Wholesale Investor. My name is Keith John, and I'm the Managing Director of Pioneer. Pioneer is an ASX-listed, Australian-based financial services provider that specialises in acquiring and servicing retail debt portfolios, predominantly out of the major banks. We operate in a sector where traditionally about 80% of all volume has gone to 4 players. In recent times, that's changed, and Pioneer is now the second largest acquirer of portfolios out of those banks in Australia. Our business model is based around being differentiated in the way that we both acquire portfolios, but more importantly in the way that we service them, such that banks prefer us over others and sell to us because we're seen as a very safe pair of hands that protects both the customer and our vendor's brand. Pioneer's differentiated approach starts with the way that we acquire portfolios. Focused again mainly on the big banks, we do not acquire lower customer segments like payday loans, for example. Our business is really focused on the higher performing segments, customers with a propensity to heal, and those that we can genuinely help. We have a strong range of relationships across all of the vendors in the market, and something that's very highly respected by Pioneer and by those vendors, such that we're always included in their conversations about what portfolios might be available for us to invest in. Our disciplined acquisition of these portfolios is really underpinned by our analytics and understanding what is a fair price that we can pay for them, such that we can make a commercial return, whilst also, of course, providing a very, very secure and safe service to the customers that we service. Ultimately, our business strives to do one thing very, very well, and that is to do the right thing all the time. That is in the way that we treat our people, the way that we look after our shareholders, our vendors, and of course, our customers. One of the ways that we demonstrate our differentiation is through Net Promoter Score. Pioneer has a Net Promoter Score of plus 23 at our most recent look back, and it's an amazing testament to the service that we provide to customers that are having a tough time. Our compliance regime is very, very solid, and one of the things that differentiates this business from others. We're regarded and we're renowned for having a great offering that looks after our customers and also underpins the way that we represent the banks that we deal with. We have a board and a management team with extensive experience who are here to guide the business and also to protect shareholders' interests at all times. From a performance perspective, you'll see that over time we've had great performance that continues to increase. One of the very key parts of our business is our portfolio. We've invested almost $500 million over the course of the last few years, and we recovered some $700 million to date, with much more to go. Our portfolio has a value of about 1.9 billion Australian dollars in recoveries that are due to us. And whilst we won't recover all of that, we do have a performing arrangements book, almost like a performing loan book, of about $370 million today, and about $1.5 billion that we're working through with those customers so that they can perform, and of course that we can get a commercial return as well. In terms of the outlook for this business, there's a range of programs of work that are going on. of those programs, it is about underscoring the validity of this business and why we are successful. And from there, it's about increasing the operating leverage and releasing that such that more of the profits flow to the bottom line. One of the key aspects of that is we're currently undergoing a refinancing to reduce the cost of funding, and it's a program of work that we hope to have cleared and finalised in the coming months. Finally, in terms of outlook, Pioneer has guided the market to an investment of $37 million. This is an amount that's less than we've invested in previous years, reflective of the changed environments caused by the pandemic. However, one that we expect to grow dramatically in the next couple of years. In terms of our earnings, we've guided the market to an amount that is EBITDA of greater than $55 million. And a lot of that money is reinvested back into our business, into growth. We thank you for your time today. Hope you enjoyed the presentation and look forward to welcoming you as a shareholder soon.
Presenting now is Image Resources, Australia's newest mineral sands mining company operating open-cut mining and ore processing facilities at its 100% owned Bunanaring Mineral Sands project. Here to talk further about this opportunity is Managing Director Patrick Moots.
Thank you for attending this presentation. My name is Patrick Moots. I'm the Managing Director of Image Resources, and I'm very happy today to give you an introduction of the company. The headline is to start where we are. We are an established, profitable Australian mining company. Some of the metrics to put things in perspective for where we sit in the spectrum of a variety of different kinds of companies. We're at a share price at 19 cents Australian per share, market cap of 188 million. Importantly, we've got $51 million in the bank as of the 31st of March and zero debt. Debt was repaid early in February of 2021. Also importantly, we've now paid our inaugural dividend of 2 cents per share to shareholders as of April 2021. A couple more metrics to help put some perspective to the size of the company, the size of the operation. We have revenue figures sitting here because we have now completed at the end of calendar year 2020, our second full year of operation. Revenue was 146 million in 19 and 176 million in 2020. And similarly, net profit after tax was 20.8 million and now 24.8 million. So that puts the perspective on the size of the company. We are definitely established and we are profitable. So what does Image Resources mine? Well, firstly, Image Resources is one of Australia's newest mining companies. And apologies for reading the slide, but I think it's important that we cover these and then investors can look at the slides separately and still get the same information. Project construction was in 2018 and importantly on time and on budget when the first production started in December. The products that were produced by Image Resources at this mine are zircon and titanium dioxide. And before I get into the specifics of those, for those that aren't familiar with them, I want to say that the zircon component represents about 80% of the company's total revenue, which you saw on a previous slide. And it also represents about 6% of global production of zircon. So we are a small mine, a small company yet, but we're growing and we do contribute significantly. Talking about the products, the first one is zircon. And as you'll see here, it's processed into a variety of zirconium-related compounds, including zirconium metal. The primary use of zircon is in ceramics, and that's in tiles, and that's in things like toilet bowls and sinks because of its high abrasion-resistant characteristics. And it's also used in foundries and refractory linings because it has a high heat resistance. And as you can see, it's also used in chemicals. The little diamond-looking item on the left is a cubic zirconia that we've heard about. And the metal bar on the right is zirconium sponge. It's used in nuclear reactors because it doesn't absorb neutrons. The titanium dioxide in our product comes from two minerals called rutile and ilmenite. And it's processed into a variety of products, including the metal itself. But the primary use of titanium dioxide is to make these ultra-white pigments that are used to make white paint white, white paper, and white plastic. And that's about 90% of the overall demand. Some from the rutile sector comes into welding rods, the flux of it. But then again, there's the titanium metal. And as you can see, both by the pictures and the text, it's used in things like aircraft engines as well as medical implants. So these are, to suffice it to say, zircon and titanium dioxide products are mainstream products. They're used in many things. And interestingly, they are tied to the GDP of the globe. As the world grows, the demand for these products also grows. So why has Image been so successful? Well, one reason is location. We have a mine location that's only an hour north of a capital city of Perth in Western Australia. And that means we're in an infrastructure-rich area. That means the cost of capital is lower. It also means people are available. But one more important aspect, it being an hour from a major capital city means that we do not have a fly-in, fly-out situation, as is often the case with mining operations. We're lucky enough to have people that can drive to work in the morning and go back home at the end of the day. And in a mining scenario, to have a good work-life balance is very important. So we've attracted some very good people. Another reason is because the mine has very high-grade ore. In fact, one of the highest-grade projects of its kind in Australia. For example, the zircon grade in the ground is 2.4%, and the titanium minerals are greater than 5%. Now, by comparison to what I'll call a typical mine of the same kind, you can see that the zircon grade might be much, much lower, and the titanium grade might only be about half. So this is a very high-grade mine, very important to overall profitability, but also high recoveries. The zircon component can be recovered at nearly 98%, actually a little more than 98%, and the titanium minerals 90%. And lastly, for this particular slide, high revenue to cost ratio of 2 to 1 means that we have a very strong margin, and this is an ability to generate good profitability. But the other reasons for being successful are that we have a simple business model. Shallow open cut mining, which is contracted to one of the best contractors in Australia in this sector. It's also just using simple gravity separation, nothing fancy here to recover the mineral. And we only make a concentrate product, and that is sold in bulk shipments. Importantly, of course, we have all of our production committed under life of mine offtake agreements, but they are at market pricing. We have strong demand for our products, and the market prices have been quite high and are even in the last few months growing higher now with the overall commodities boom going on in Australia. So what are Image's growth plans? Image has 12 zircon titanium related projects in its portfolio. They're all 100% owned. All of them are in Western Australia and all sit within an area of about 1,000 square kilometers. They all also have mineral resources already identified. This is under the Australian JORC code. And 2 of them already have ore reserves. 1 we're mining, and 1 will be the next one that we mine when this one is exhausted. But only the first of these 12 has been developed. And so you can imagine that in our growth plans, that includes looking at additional projects for operation. So the growth strategy is multifaceted. We will definitely continue to use the existing capital equipment to operate profitably as we are now and have for the past 2 years. But we're actively looking to develop a second mining operation, and we're progressing quite well on feasibility studies already on that second operation. Since we are in a debt-free situation and profitable, we also are investigating opportunities to invest in development-ready projects outside of our portfolio. We will be able to partially, if not wholly, self-fund some of these investments if we find the right one for us. And of course, today we have access to very low-cost debt from, say the big 4 banks. So this is a very important position that Image finds itself in to be able to look at additional investments. And the last thing is we're actually investigating the potential of a profitable gold mining center on 2 of our gold-focused tenements. I put this slide up to just show those that are more interested in the hard numbers on market guidance, for example, for 2020. We met our guidance both 2019 and in 2020. You can see the numbers here for 2020, and what this also provides is the guidance that we produced for 2021 relative to 2020. And we've completed our first quarter in 2021 already, and there's no need to change the guidance at this time. We're exceeding our target ranges so far. Look, the beyond operations, though, there's an important aspect that the company focuses on, and that's looking at growing into a mid-tier mining company and a sustainable mining company. And of course, the areas that we focus on, therefore, include health and safety of all our employees and the local community, all kinds of environmental protection issues around the site, but also off the site, and we'll talk more about that. And importantly, community relations issues, both with landowners and local community organizations. In short, we do focus on maintaining our social license to operate. It is a very important aspect for sustainability. This slide just shows a few of the organizations, mostly non-for-profit, that we do help support in the area. We provide a significant amount of local employment in the area as well. I think it's notable to mention that while we are in a high infrastructure area and we have access to grid power for our operation, we chose to put in a solar farm to support and partially offset our carbon footprint. That was installed and it is in operation, and it produces about 25% of our total electricity requirements, and that will continue to operate for some time to come without a doubt. This is just a picture of the solar farm in the area where we operate. These last pictures are basically what I call look out the window of the plane, but they're really from a drone. Looking at the mine area before mining operations, this is April 2018. And what I'm showing here is the progression of mining and mining complete, but backfill starting. This is now December of 19. And the last slide here in August of 2020, less than 30 months when we broke ground on the mine, we've already completed rehabilitation, including revegetation of the first 13 hectares. This is another important aspect of our environmental consciousness about making sure we return the land to its previous use category as quickly as possible. Another initiative we're working on is carbon sequestration research. We've just begun working with local landowners who are working in cooperation with some research institutes under what is called the Australian Carbon Farming Initiative. And the point is, or the goal is to make a way to improve the soils, to improve their carbon sequestration capacity. This is a very important carbon sink that can be enhanced in Australia, and we will have additional information about this as we go forward. But it's just another step in the company recognizing we need to do our part of looking at how we can continue to protect the environment overall. So in summary, why would anyone want to invest in Image Resources? Well, let's just summarize. Number one, we are a proven profitable mining operator. We paid our inaugural dividend already in 2021, and we do have a goal to continue to pay an annual dividend. We have multiple 100% owned projects in our portfolio for future production. Our growth strategy includes developing a second operating center in parallel to existing operation, which, by the way, could double the value of the company in the market. Also investigating opportunities outside of our portfolio to develop another project, one that's development ready. And lastly, investigating the opportunity for a gold mining operation on our tenements. Look, in short, we're working to maintain strong focus on our environmental, social, and corporate governance issues while maintaining our social license to operate. That's the story from Image Resources. There's our website located at the bottom for additional information. Thank you very much for your time.
Presenting now is Predictive Discovery, an ASX-listed West African gold explorer, currently progressing its 100% owned Banxa project located in the prolific Singiri Basin in Guinea. Here to talk further about this opportunity is Managing Director Paul Roberts.
The key message for Predictive right now is that we're nearing a maiden resource estimate at Bankan, particularly Northeast Bankan and also Bankan Creek. We have 3 active rigs, all diamond drilling currently, and we're also doing auger drilling at the same time. And there is really substantial exploration and discovery opportunity elsewhere in the Bankan project. And I'll be talking about this and referring to a slide which actually comes out of a release that's come out since questions were invited. So the corporate overview, we have approximately a bit over $9 million in cash on hand currently, so we're very well funded. Our market capitalisation is obviously varying, but we have seen an increase in the share price over the past month, and we're hovering at or above 9 cents, which is very gratifying. In terms of the board and management, the most important additions to the board have been Francis Harper in recent months. Francis Harper as non-executive chairman, Andrew Pardey as non-executive director. Francis is also the chairman and a major shareholder of Tieto, which has been successful. He was the original chairman of West African, WAF, in Burkina Faso. That's also been a great success. Andrew Pardey, a very distinguished career in geology and particularly in mine development, and played a critical role in the development of the Sukari mine, a very large gold producer in Egypt. So this, of course, refers to the new imagery that we've just put out. And on the right-hand side, this is new aeromagnetic data indicating some very interesting new targets that we've identified. And also puts that in the context of where the Northeast Bankan and Bankan Creek prospects are. So the ground position here is 358 square kilometres. It's a very large area of ground. And most of our drilling, that is our exploratory drilling outside of Northeast Bankan and Bankan Creek, has been auger drilling around, a little to the north, a little to the south, to the east and west of Northeast Bankan and Bankan Creek. A little bit of work down in the far southeast, and recently we've been drilling up in that Argo area to the north. We have no results from that yet, but we're certainly doing auger drilling up there. What's important from this slide, of course, is that we've identified new targets, and we've identified them through the aeromagnetics. And what we can see is what appears to be a very major linear structure traversing the entire permit area. Up in the northern northern part of the permits, it looks as if it actually provides a dividing line between granitic basement to the west and the mixture of sediments and mafic volcanics that we see in the Siguiri Basin to the east. And Northeast Bankan itself is very close to that structure. We think that it sits on parallel structures, but there are also interesting cross structures or cross features that we're seeing coming through there that we think potentially provide more loci for finding more gold deposits. Added to that, in several of these areas, we're also seeing artisanal workings, thus far untested, and so we will be pursuing all of those, particularly within these circles, as well as the areas where there are no artisanal workings, because we've demonstrated by past exploration that you can actually find mineralisation in areas where there are no workings at all. So a lot of work to do, very exciting, very large area. But what this magnetic survey, magnetic and radiometric survey has done is it's given us the ability to focus, because it is physically impossible in any reasonable period of time to carry out auger drilling, which is our primary exploration method over the whole area. So this is the more familiar image on the right-hand side, just highlighting the diamond drilling, the west to east diamond drilling and RC drilling that we've completed over the whole footprint. and particularly highlighting the central zone. The central zone is critical to the future potential and economics of this deposit, and that's because we have thick zones of mineralisation extending down to depth. We have also been doing oxide drilling over this broader footprint, this pink area, this pink contour that we see, the dark pink contour, and we have more results that will come out on the oxide drilling. So turning to the longitudinal projection, this requires a little bit of explanation. There are notes, and these notes have been provided in all of the ASX releases, but it's important to understand what this is. It is actually a projection of the whole zone with a particular focus down in the fresh rock. So you can see the base of oxidation there. Above that, we're in the oxide zone. Below that, we're in the fresh rock, mostly in these granitic rocks, these so-called tonalites. And what we're seeing there, you can see three numbers for each of these holes. The first number is the aggregate width of reportable gold mineralisation above 0.5 gram. So and the reason that we've included an aggregate width, which is a little unusual for longitudinal projections, is because this zone is so thick, and because there are multiple bands of mineralisation, unless you show the aggregate width, it doesn't become clear where the focus of interest and potential is. So first number, aggregate width. Second number, length-weighted average grade within that aggregate width. All intercepts above 0.5 gram. And then the third number in brackets is multiplying the two together. That's the gram metre. And the gram metre calculated so that we can draw contours and we can show the greatest focus of mineralisation. So that dark pink zone in the middle is the greatest focus of mineralisation. It is extending to depth. These holes go down to roughly 220 metres vertical depth. But in fact, we believe that there's very considerable, just because the mineralisation is so consistent, that the mineralisation will continue on. And we believe that the ultimate limit for open pit mining, because it is so thick, will be possibly of the order of 300 metres. Some people even suggest deeper. And within that pink zone, particularly the central zone, you can see we're getting average. We're getting average aggregate widths of 90 metres, perhaps. Average grades are around 1.4 grams or thereabouts, obviously quite variable, up to 2.7 grams. So you are talking about a very significant body of gold mineralisation. In the outer area, the plus 50 gram metre contour, we're still seeing very good widths. Grades generally are a little bit less, but certainly that material will be mineable as well. Turning then to the cross sections, we've got 4 cross sections to show you here, but there's really just a couple of things which are important to point out. The first thing is that we have a very wide zone, about 200 metres wide on these sections, largely mineralised in the oxide zone. Now, clearly, that's a very good thing. And the reason for that is because in the first phase of mining, you'll be starting at gold from surface or almost at surface. Nearly everything that you'll mine in the initial pit down in the oxide will be mineralised. There's very little waste rock to move. In the oxide zone, which is within that pale yellow black band, the rocks generally are soft. So mining costs will be low, and doubly low because there's very little waste rock to move as well. And in oxide zones, we find that metallurgy is generally without any problem. Recoveries are very high, and that's because the process of oxidation actually releases the gold. So a lot of very exciting economics there, very broad zone, quite a large pit just down the oxide. And the second thing to point out is that we've got these bands of mineralisation, and they join up from hole to hole. So on the RD9, BNE RD9, we've got 51 metres of 1.4, followed by 50 metres of 1.3, followed by 44 metres of 1.4, followed by 54 metres in the oxide, where grade's a bit low, 0.7. A very nice, consistent mineralisation. And then most encouragingly in this hole, that second intercept, 14 metres of 7.2, which comes down from 42 metres of 2.3, higher grades, and the deepest hole on this section so far. So clearly potential to extend further. Nice flat dips. And so that really brings you to the, or shallow dips, and that brings you to the other real benefit of this deposit is the eastern side, the right-hand side of this section is depicting the footwall side or the eastern side of the open pit. So mainly waste rock mining will actually be to the extent the waste exists within the deposit between these bands and then above. And so, down to a few hundred metres, the stripping ratio is remarkably low. And of course, that drives economics and one of the reasons why we can drill so deep. Section. And again, really these other sections are better to refer to. They will be up on the internet, on the website. But the same message, broad zone here, more than 200 metres wide, multiple panels of mineralisation joining up. Again, we see the same message. On this section, we see this flattening. Now, obviously, the flatter the zone goes, so you've got that 34 metres of 1.7 followed by 28 metres of 1.2 grams, still at quite shallow depths. And in fact, down to the limit of mineralisation, the actual length down the plane of mineralisation could be as much as 500 metres. This is a big gold deposit, and certainly these kinds of results are very exciting. And then finally, one last zone here. And again, we're seeing that continuity from hole to hole to hole, the 60 metres of 1.4, the 17 metres of 1 and 30 metres of 2.6 aggregate, about 50 metres of 2 grams, slightly lower grade as we go up into the oxide, but we got 52 metres of 1.5 in that stream zone. So a very nice continuous story, tailor-made for mining on a very large scale, very predictable kind of deposit, and extending it to very significant depths. And then 3 kilometres away, we have Banxa Creek, satellite deposit. We now know of mineralisation over about 300 metres, maybe a bit more than 300 metres. We do need to infill drill that with RC to calculate a resource, and we'll be doing that in May. And here's a cross-section, and just demonstrating what we reported before, the shallower hole. This is the KKODD 20 hole, had a width, if you average everything, including the intervening waste, of 92 metres, with an average grade of 1.9, a splendid intercept down below, similar amounts of gold, a little bit more spread apart. Clearly, this is a deposit that's got real potential to add ounces to the overall resource. We will be drilling it on closer spacing, and that's because grade distribution isn't quite as predictable as we see in Northeast Bankan. And we obviously want to add this into the resource statement.
Presenting now is Calima Energy, a publicly listed mid-tier oil and gas producer in Western Canada. Here to talk further about this opportunity is Chairman Glenn Whitten and Managing Director Jordan Keval.
Hello everyone, my name is Glenn Whitten and I'm the Chairman of Calima Energy. I'm joined today by Jordan Keval, the CEO based in Alberta, Canada. Calima is a conventional oil and gas producer in Canada. We have assets in the Brooks and Thorsby, where we're currently producing 2,800 barrels of oil equivalent a day. And we have a very, very large liquids-rich Montney play, which will be delivering gas into the LNG story in Canada. As a conventional oil and gas player in Canada, we are a very low-risk opportunity, and we have 2 assets that are currently in production. The key for our Brooks and Thorsby assets are they're very low decline, and they generate very high cash flow at $60 oil. The other benefit that we do have from our asset that we drilled 3 years ago in the Montney is we have a gas resource of just under 2 TCF of gas that will be able to deliver gas into the LNG industry in Canada, specifically LNG Canada, operated by Shell, which is anticipated to come into production in 2024. Just as a snapshot on the company, we currently are trading on the ASX under the symbol CE1. And we currently have quite a large number of shares, 10.2 billion shares on issue, that have resulted from a recent capital raising we did to fund the acquisition of Blackspur. We intend to undertake a consolidation of our share capital over the next 3 to 6 months once the share price of Calima sits down post-acquisition. Our market cap today is around $70 to $80 million, depending on the share price, and we actually have around $13 million of debt and a cash position of around $3 or $4 million. The debt position is actually provided by a very large Canadian bank called National Bank of Canada, and the total facility is for $25 million, of which only $13 million is currently drawn. The assets that we have today generate a significant cash flow of the company, currently around $4 million a month, and we're earning around $2 million EBITDA a month. The objective at the moment is to maintain and keep production at 3,000 barrels a day, but also to grow it quite significantly over the next 12 months. We have a very low break-even of $26 a barrel, and most importantly, we have a very low operating and transport costs of $10 a barrel. So if the oil price does fall, which we fundamentally don't believe it will, we are protected down to $10 a barrel. Most importantly, we have 26 million barrels of PDP reserves and 2P reserves, and a 2T contingent resource of 192 million barrels, or just under 2 TCF of gas sitting in the Montney. One of the things for Calima that sort of puts us and stands us out from our peer group is we have a very low risk, de-risked asset base. Our partners, or our subsidiary now, Blackspur, which we've acquired, spent over $200 million on their assets over the last 7 years, and that involved the acquisition of land, leasing of land, facilities, infrastructure, seismic, and drilling wells. These assets today generate a tremendous free cash flow for the company, and a rising energy price will generate even more cash flow for us. We've got LNG market exposure, as I mentioned, and we actually have very strong netbacks. What we are doing is we're committed to generating returns that we can share with our shareholders. Myself being one of them, I was a significant participant in the recent raise that was undertaken by Calima, and have been a shareholder of this company for many, many years. Today, we currently produce just under 3,000 barrels a day of oil, as I mentioned, and we are going to be drilling 1 development well a month for the next 24 months. Our objective is to grow to 5,500 barrels a day as quickly as possible. We've actually advised in earlier presentations that we think we could achieve that by the end of 2022. My belief is that with the oil price of around $65 a barrel as it sits now, we'll be able to achieve that production base much quicker. We'll also look at advancing our Montney acreage. There's a lot of consolidation going up in the Montney with Tourmaline and others, and we believe that we'll be able to undertake a strategic acquisition or consolidation with our Montney acreage over the next 12 months. In the longer term, while we say we want to get to 5,500 barrels a day, our target really is 10,000 barrels a day over the next 3 years, and we do believe with the existing assets that we have, we can achieve that. The upside also for us is actually expanding our reserves and resources, acquiring new assets through Crown leasing, and also through consolidations and acquisitions with peer group, smaller companies in our immediate peer group. From a valuation perspective, we're really quite undervalued. We're sitting at 3 times EV to 2P multiples, and that compares very well in terms of the average peer group in Canada, which is 6 times, and the average peer group in Australia, which is 10 times. The acquisition that we undertook of the Blackspur assets was really quite opportunistic, and we were able to do that acquisition because we spent the second half of last year evaluating and identifying new acquisitions. And in November, when the oil price was $45 a barrel, we entered into an agreement with Blackspur and their shareholders to acquire the company. At the time when the oil price was $45, many in the market didn't think it would rally. We had a fundamental belief that years of underinvestment in the oil and gas sector would result in increasing values for energy prices. And secondly, we believed that, like Australia, when the rest of the world came out of COVID, the economy would boom. And to date, we've been correct in that assumption. The oil price has moved from $45 to $65. And as I mentioned, our operating costs are $26 a barrel, all in, including royalties. And so at $65 a barrel, there's a tremendous net free cash flow that's generated by the business. As you can see on our EBITDA slide here, At $60 oil with 3,000 barrels a day of production, we produce $25 million of EBITDA. This is Canadian dollars for simplicity. And also at $60 a barrel, when we produce 5,500 barrels a day of oil, the combined Blacksburg Calima assets will generate $58 million of EBITDA. That's measured that against our current market cap today of around $75 million. The metrics actually are very advantageous for us. We though fundamentally believe that the oil price is going to rally in North America once it comes out of COVID. The vaccine program is actually very successful. As I mentioned, years of underinvestment in the oil and gas sector is resulting in supply constraints and demand will switch on very quickly. And when the oil price runs to $70 a barrel and we're producing 5,500 barrels a day, we'll generate around $73 million of EBITDA. We've got a great board and management. The company is actually run by Jordan Keevil, who was the original founder of Blacksburg, Braden Basur, who's our CFO in Calgary, and Mark Freeman, who's our CFO here in Australia. We're running the operations from Calgary. The Australian operations are very small, being myself and Mark Freeman, and we're basically here to meet the compliance, the regulatory, and the corporate governance side in Australia with the guys who know the assets and actually built the assets, Jordan, Braden, and the Canadian team running the assets.
Slide 10 illustrates a snapshot of the two core areas on the Blacksburg assets. We have Brooks and Thorsby. The Brooks area produces about 2,300 BOEs per day currently. And there are 147 net identified locations on the Brooks asset base. And in the Thorsby area, we produce about 550 BOEs per day. And there's about 101 net identified locations across the Thorsby asset base. Brooks has 9.1 million BOEs of 1P reserves and 11.6 million of 2P. And Thorsby is 7.6 million of 1P reserves and 10.9 million of 2P reserves. Looking at each of these areas in a little bit more detail, this is the Brooks area. Green is the Calima land and all of the associated wells on that land. We also show where all of our oil processing facilities are in the green barrels. We have a very large footprint of infrastructure in the Brooks area, and it is spread across our entire asset base, which is very good for all of our upcoming drilling programs, as all of these facilities are underutilized and have a lot of room in them for future drilling. The 147 net locations identified are spread across these 83 net sections, and this is the area that the upcoming Brooks drilling program is going to be focused on. What's interesting about Brooks is we're only about 1,000 meters deep here for the target formation, the Sunburst. As well, the Sunburst is a true conventional play in that there is no fracking. So we can drill, complete, equip, and tie in these wells for $1 million. And the drilling takes approximately 7 days. So it's very quick turnaround times and very low input costs because of the lack of fracking on this conventional oil play. As well, the economics are very strong in the Sunburst. At $60 WTI and $1 million of input costs, we're generating greater than a 500% rate of return and about a 0.5 of a year payout for our type curve Sunburst conventional well. And that's based on 22 wells that Blacksburg has drilled in the past on our land base. It is the average of the results of those wells. So it is on the conservative side for a type curve and extremely strong results. This is our core play, and this is going to be the focus of our drilling in the next 18 months. Moving on to Thorsby, a similar situation here. Green shows where our existing land base is. There is 108 net sections in the greater Thorsby area that Calima owns. Blacksburg has drilled 11 wells to date in this play. And we have built our own infrastructure here. We have 2 oil processing facilities. We have a number of existing pads that all of our wells have been drilled from, and the majority of our future wells are going to be drilled from these same pads to keep costs low and for efficiencies on the drilling side. We're about 1,350 meters deep here, so a little bit deeper than the Sunburst play in Brooks. As well, these are fracked wells. So the all-in cost for a Thorsby well in the Sparky formation is $2.5 million. And at our tier 1 type curve, based on $60 WTI, we're generating a 382% rate of return, and we have about a 0.5 of a year payout. However, in our economics, for a bit of conservatism, we use our tier 2 type curve. And at $2.5 million, that still generates a 242% rate of return, and it's about a 0.7 of a year payout. So very strong economics in the Thorsby area as well. These wells come on at about 350 barrels per day of oil, IP30, so versus the Sunburst Formation, which comes on at about 160 barrels per day, IP30. The costs are a little bit higher because of the frac versus the no frac in the Sunburst, but very strong IP rates and very strong related economics. Moving on to the Montney, this is a snapshot of where the Montney trend is relative to the other unconventional plays in North America. So Calima has a 60,000 acre package in Northeast BC in Canada. The greater than 30,000 of those acres have been turned into 10-year continuation leases based on the drilling of the 2 wells that Calima drilled into the Montney in 2018. And upon a future development in this area, based on the Tommy Lakes facility that Calima owns, this area could be ramped up to 11,000 BOEs per day based on the existing infrastructure. Once we tie in the well pads to the facilities with a 20-kilometer pipeline, this is a large-scale future development play for Calima, and we've been very pleased with the price of gas, natural gas. The AECO benchmark has been very strong as of late, so we are watching that very closely and looking forward to a future development on this Montney acreage in the coming years.
One thing that's been going on in the Montney has been significant consolidation by the majors. Tourmaline, Canadian Natural, ConocoPhillips have all spent a couple $2 billion buying up surrounding competitors. We are one of the few competitors left in the yellow, and we believe that we will participate in that consolidation over the coming years. As I said, we've got some guidance out there at the moment for 3,000 barrels a day. Our real target is to try and increase that guidance to 5,500 and then 10,000 barrels a day, basically accelerate our drilling plans while the oil price is high. Because if we can recycle our capital in 6 months, it's a tremendous opportunity for us to actually build a long-term annuity base that will allow distributions of dividends or return of capital to shareholders. One thing which we'll always do is we'll always enhance the upside of the opportunities. With the Brooks, we have the opportunity to do a water flood that again will increase the production base, and as I mentioned, undertake land acquisitions. I guess one of the things that we do have today is that we've got an asset base that actually will generate tremendous capital or tremendous cash flow going forward, generate opportunities for us to distribute cash flow to shareholders, and most importantly, unlike most oil and gas exploration companies, we have the ability to develop these assets on a low-risk basis because we have 26 million barrels of 2P reserves, and we have in excess of 100 drilling locations that have already been booked and certified by independent auditors. So really where we're going to take this company is in a growing oil environment. We're going to grow the production, grow the cash flow, and also grow the business so that we can actually go participate in a rising energy market from $65 to $100 a barrel oil and a rising gas market, and actually share that with our shareholders. So thank you very much for your time. Much appreciated. Any questions, you can find us on the website. Thank you very much.
Presenting now is Telix, a late-stage radiopharmaceutical company developing a broad portfolio of diagnostic and therapeutic products. Here to talk further about this opportunity is Chief Business Officer David Cade.
Welcome to the Wholesale Investor small cap event, and I'd like to thank Wholesale Investor for their invitation to Telix to present at this year's event. My name is David Cade, and I'm the company's Chief Business Officer. This is the usual disclaimer. I'll open with a simple description for those who may be less familiar with the company that I think summarises nicely how Telix's technology works. Essentially, Telix develops molecularly targeted radiation, or MTR drugs, that use a targeting molecule to carry a radioactive payload directly to the cancer cell. Radiation oncology is a fundamental part of usual cancer care, but it traditionally involves the use of external beams of radiation that are aimed at the patient to destroy cancer cells. But with MTR, we use a drug to carry a radioactive payload in an extraordinarily precise way. And the advantage of this, unlike conventional radiotherapy approaches, is that we deliver a systemic therapy, including hitting the microscopic disease that may otherwise often be missed. And so with a low dose or the use of a diagnostic radioisotope, we can use a PET scanner to image the patient's cancer with very high accuracy. Whereas if we increase the dose or if we use a therapeutic radioisotope, we can then treat the same patient. So that's really seeing the disease and then treating the disease. And it's really a very powerful form of personalised medicine. Telix is a radiopharmaceutical company with a broad late-stage portfolio of MTR assets spanning prostate, renal, glioblastoma or brain, and hematologic or blood cancers, as well as several high-value rare disease applications. The company's most proximal to market product is the company's prostate cancer diagnostic imaging agent known as Illuccix, which presently has regulatory submissions in 17 countries underway. And this includes the United States and Europe. Illuccix is expected to commence receiving those marketing authorizations in the second half of 2021. During 2020, the company completed the acquisition of a radiopharmaceutical production facility in Europe, as well as a number of other important transactions, including our strategic partnership with China Grand Pharma and the acquisition of TheraPharm. And I'll go into more detail on the three major future inflection points for 2021 in a moment. This summarises Telix's growing pipeline of imaging and therapeutic programs. And I won't delve into a lot of specific detail here, but I will highlight four key observations that I think are worth taking away. The first of these is that Telix's prostate cancer imaging agent, Illuccix, is the company's most proximal to market product. This product has a total addressable market value in the United States of approximately $850 million US, which I'll describe shortly. The second point to make is that Telix has a fast-following renal cancer imaging agent known as TLX250-CDx. This asset is nearing completion of phase 3 development in a trial known as the Zircon trial and has been granted breakthrough therapy designation by the US Food and Drug Administration, indicating that this asset stands to address a major area of unmet need in medicine. The third point I think worth highlighting is that Telix continues to augment its portfolio in urologic oncology, particularly prostate cancer, including with new products that we believe extend the reach of our core technology into different clinical application areas, such as radio-guided and image-guided surgery. These developments are closely aligned to Telix's objective of building category leadership in urologic oncology. And then finally, the fourth observation is that through Telix's December 2020 acquisition of Swiss-German biotech company TheraPharm, Telix has built an attractive position for diseases that are treated using bone marrow conditioning. And these diseases include such diseases as multiple myeloma, leukemia, and other high-value rare diseases. This summarises the anticipated regulatory timelines for Telix's prostate cancer imaging product Illuccix in the main regulatory jurisdictions. But in summary, Illuccix is currently being reviewed by regulatory authorities in 17 countries, with the first regulatory approvals anticipated by Telix to be granted from the third quarter of 2021 onwards. Here I've outlined the total addressable market for Telix's prostate cancer imaging product Illuccix in the United States and in Europe. So while an almost 480,000 men were diagnosed with prostate cancer in the US and Europe last year, approximately 3/4 or 75% of those men, amounting to about 360,000 of them, would benefit from imaging of their prostate cancer with Illuccix across the 4 main potential disease indications for this form of advanced imaging. And if you look at the value that this represents, this is a total addressable market value of approximately $850 million across the United States and Europe markets. I believe it's an accurate statement that Telix has an outstanding board and I think senior management that is exceptionally strong in both healthcare sectoral experience as well as very high quality governance. Telix's presence really is genuinely global, with the majority of the company's people located outside of Australia, in the United States, Belgium, and a small group in Japan. So to wrap up and looking ahead, the key value inflections for Telix in 2021 may really be summarised as commence, complete, and launch. So the company is going to commence its ProstACT phase 3 prostate cancer trial, and this will see Telix become a true phase 3 oncology company, which is a very big milestone for a company like Telix. We're ready for that trial. We have the manufacturing and the clinical relationships in place, and thus it's really a highlight for the company calendar during this year. Secondly, we expect to complete the phase 3 Zircon trial for renal cancer imaging by finishing patient enrolment around the middle of this year. And then with our breakthrough therapy designation, we have a rapid pathway through to a product approval with the US Food and Drug Administration, which we anticipate to occur during 2022. And then last of all, launch. Launch refers to our first internally developed commercial product, Illuccix, for prostate cancer imaging, where we have 17 countries in which that product is currently under commercial launch planning. So a very significant undertaking for the company and a major focus for us right now. So thank you for your attention, and I will conclude there.
Presenting now is Banxa, an internationally compliant payment service provider servicing crypto exchanges, wallets, and other cryptocurrency businesses. Here to talk further about this opportunity is the founder and chairman, Dominic Carosa.
Hi, my name is Dominic Carosa, founder and chairman of Banxa Holdings Inc, TSX code, Toronto Stock Exchange code BNXA. And for all the Australians out there, you can actually buy Banxa via CommSec or full service brokers like Bell Potter, Macquarie, and other brokers in the Australian marketplace. And we're also available in the US with code BNXAF. What I'd like to do today is just take you through the investor presentation. And maybe before I start talking about Banxa specifically, I just wanted to give everyone a bit of an overview around the whole growth of the crypto market. It's very much moving out of the domain of the tech nerds, and I'll put up my hand and say I'm one of those, to really being the domain of the institutions, the family offices. And one of the other key metrics that we're starting to see is the significant growth in the number of wallets out in the marketplace as well. And at the same time, we are also very, very early in the evolution of the whole crypto or Bitcoin ecosystem. We've also, I'm sure, also heard of Elon Musk talking about Bitcoin. Tesla now actually holds Bitcoin as part of their treasury. Instead of holding cash, they're actually holding Bitcoin. And then Paul Tudor Jones, who would be considered the father of the modern day hedge fund, he started buying Bitcoin mid-2020, and he views Bitcoin as one of the best inflation hedges out there. And so there are many reasons why different investor groups are now starting to flock to the whole digital asset system. Our vision at Banxa is really about bringing digital assets to every part of the globe. And so let me give you a quick snapshot. Banxa is the world's first stock exchange listed PSP, payment service provider for the digital asset industry. We're like the PayPal or the Stripe for the crypto industry. And what we're effectively doing is building the bridge between the traditional fiat world, and when I say fiat, I mean AUD, USD, Euro world, with the digital asset world. And when I say digital asset, I mean Bitcoin, Ethereum, Litecoin, Dogecoin, and all the other coins. So effectively, we're doing this through what is called the on and off ramps, the fiat on ramps and the fiat off ramps. And that's very much the business model. Our model is B2B, and we're like effectively the picks and the shovels of the industry. So we're building out the payment infrastructure. And really importantly, whether the price of Bitcoin goes up or down, we still clip the ticket. So our business is not correlated to the actual price of Bitcoin. Now, there are 4 key pillars to our business, which I'll go through. First of all, we operate a global and local payment platform. For example, we offer MasterCard, Visa, and Apple Pay, as well as local payment methods like Poly in Australia, Faster Payments in the UK, Ideal in the Netherlands, and the list goes on. And so we effectively have a whole series of payment options, which is wrapped with our regulatory and compliance layer, because unlike when Banxa got involved in the business in 2014, the whole industry is now highly regulated, and we obviously do full things like AML, KYC, and other related checks. And we have a number of registrations and licenses around the world. Thirdly, we have our data science automation platform, which is basically the technology stack that does the heavy lifting, that manages the business on a day-to-day basis. And as we like to say, the business technology basically makes money, helps us make money while we sleep. And then ultimately, the fourth part of that is we will deliver the coin directly to the customer, whether that's on-chain or off-chain. It's just a few different ways that we deliver, but ultimately what we do is we do it in the most efficient manner for the consumer. So how our business operates is we wrap all of the payments, the compliance, and our technology together into either an API or a widget, which is just another way to basically say a connection. And we connect this to global exchanges around the world. And some of these names you would have seen, like Binance and KuCoin and Huobi and Changely and Shapeshift and many, many others. And so we help our customers acquire new customers because we take care of the payments, the compliance, and we just effectively let them get on with the job with running either a wallet or a crypto-to-crypto exchange. The way that we make money is that we clip the ticket. We make between 1% to 3% on both the commission and the spread. And so that's our revenue model today. Moving forward, we will be offering other products and services like interest-bearing accounts, borrowing and lending, fiat wallets. So that's really what we call layer 2 services. Today, our focus is on what we call layer 1, building out the payment infrastructure. And over time, we will start adding other layer 2 services. One of the key measures and ways that we measure the performance of the company and how we communicate this to market is through a measure called TTV, Total Transaction Value. And as you can see on your screen, in the March quarter, we did over 200 million of TTV, which was up from just over 100 million in the December quarter. And the trend, all I'll say, I can't obviously make forecasts, but what I will say is the trend is continuing. In terms of the capital structure, we have just under 45 million shares on issue. We have a number of stock options, which significantly align our investors with our staff. So we have employee ESOP, which means every single person in the organisation in one way, shape or form is a stakeholder of the company. And as I mentioned before, we're listed on the TSXV, the OTC in the US and Frankfurt in Germany. And there's some research available on the company as well. You just go to banxa.com, click on investors, and you'll be able to see some research notes from a couple of groups. In terms of some of the comparables, Banxa's the new kid on the block. We've been listed since January 2021. There's a number of other companies that have been listed for much longer than us. By way of example, I guess my view is the Voyager business, is similar in terms of the evolution compared to the Banxa business. They've been listed for a number of years, so they've actually had time to build reputation and trust in the marketplace, and they have a market cap of over 3 billion. Our market cap today is between 250 to 300 million Canadian. In terms of the top shareholders, board and management are absolutely aligned, holding 25% of the company. The next three investors are all institutional funds based out of Australia and Singapore. That's Allium, NGC, and Thorney. And then we also have a number of customers, OKX Exchange and KuCoin Exchange, who are also holding shares and are sitting on our register. Moving forward over the next 12 months, we expect continued growth of our TTV, total transaction volume. These are just really some of the key catalysts that you would expect. Continue to grow our B2B customer base. We have a target of 500 over the next 18 to 24 months, and continue to expand the number of coins, moving into DeFi, NFTs, as well as continuing to expand payments into Latin America, Asia, the Middle East, and Africa. In terms of our team, as mentioned, I'm the founder and chair. We have three non-exec directors, Matthew Kane, Dodon Cohen, and Jim Landau. Between the three of them have over 50 years of public company and technology experience, led by our CEO, Holger Adians, who, as you can maybe tell by his name, is a German national. And as I like to say, he runs the company with German precision. And then we have Constantine, who's ex-EY, Josh, ex-EY, and Ian Clark, who's ex-Goldman Sachs, who rounds out the team. So that's really, rounding out the presentation. If you have any questions, investor@banxa.com. And maybe if I can just leave you with one note. If you believe in the hypothesis that the digital asset system, Bitcoin, Ethereum, and this whole ecosystem is only going to become increasingly more important over the next 3, 4, 5 years, then in my view, Banxa is very well positioned as being the picks and the shovels of the industry to take advantage of the growth. Thank you very much for your time, and looking forward to seeing you on our register. Ciao.
Presenting now is White Rock Minerals, an Australian minerals exploration and development company with activities focused on 2 major projects. Here to talk further about this opportunity is Managing Director and CEO Matt Gill.
Hello, ladies and gentlemen. My name is Matt Gill. I'm the Managing Director and CEO of White Rock Minerals, and I will present to you today on White Rock and our story. You'll be able to find this presentation on our website, a far more fulsome presentation, so I'll leave you to read the disclaimer at your convenience. So in a nutshell, what is White Rock? In one slide, we're ASX listed. We also have a cross-listing on the OTCQX, which is in the US, and I'll explain why, but primarily it's because we have a US asset as well as a New South Wales asset. Our US asset is in Alaska. It's the Red Mountain silver-rich zinc VMS project. And we also have an advanced gold and silver project here in New South Wales. And we have a third leg to the White Rock investment proposition, in that we are in the process of merging with an ASX-listed company called Ozstar Gold. And that company has a large exploration tenement package and a small producing gold mine. So a little bit more detail. Red Mountain, as I mentioned, for those listeners that aren't familiar, there's an international code that allows you to state the contained tonnes and grade and metal called JORC. We have a JORC resource for our Red Mountain asset, running over 9 million tonnes and about 600 grams a tonne silver equivalent. So significant asset there. We have about 800 square kilometres under tenement holding, and that gives us a great strategic position. We also have in the same land package a large 30-kilometre square gold anomaly called Last Chance. So we're blessed with silver zinc VMS in this land package, but also a gold target. And I think for the investor, if there's one key message from this presentation, is that we are fully funded to run a 3 drill rig exploration program in Alaska, and that should generate some pretty exciting news, and I'll talk a little bit more about that. We also have our advanced Mount Carrington Gold and Silver project. That's the subject of a joint venture with ASX-listed Thomson Resources. So again, for White Rock shareholders and investors, we get free carried through the next step of that project, which is approvals. It's got great financial metrics, a payback of just over a year. It generates over $30 million of free cash a year from the gold before we even mine any of the silver, and that's $30 million per annum. So a great little project there in New South Wales. So a little bit about our capital structure. We have about 90 million shares on issue, as I mentioned, ASX listed. We just raised 8 million. So we've got about $18 million in the bank, which is not bad for a market cap of about 39 million. Our share price came off a little bit with the capital raising. This is not financial advice, but I think that might present not a bad buying opportunity. Certainly when you consider that we've got good cash in the bank to now execute our exploration program. And we've got a good range of institutional and high net worth investors. I think an investor should always look at who else has put their money into the company, and they've done their own research. The largest shareholder we have is Crescat, so Denver based out of the US. But we've also got companies, investment companies based in Europe and also in Hong Kong, as well as here in Australia. Very quickly, our team, 3 on the board, 2 of us are mining engineers. The team consists of 2 geologists, so a good spread of mining engineering and geology to run a resources company. And then Jeremy, based in London, is also in the resources space, more in the analyst M&A. So between Jeremy in London, Peter, my chairman in Perth, myself here in Melbourne, and Quinton in Denver, we've also got a great international spread as well, and I think that's important. So Red Mountain, it's in central Alaska. It's about half an hour chopper due south of Fairbanks, the second largest city in Alaska. Alaska is in the top 5 of the Fraser Institute, so a great jurisdiction in the world to work. As I mentioned, we've got a great land package, a great JORC resource, but we also sit in this large gold belt called the Tintinnet Gold Belt, which is host to over 200 million ounces of gold. So as I mentioned, we're blessed with 2 geological domains in our one tenement package. And there you can see our tenement package. And what are we going to do this year? And I think this is the exciting bit with our funding. We're going to be drilling our large high-grade silver zinc VMS out in the east there, the Dry Creek, which is open at depth and for a kilometre along strike. What else are we going to be doing? A second drill rig will be drilling our large gold anomaly called Last Chance. We only discovered it in January last year. We got a lot of sampling done. We actually got a few holes into it. That told us we weren't drilling deep enough, so we're back this year to drill deeper. So it's our second drill rig on gold. And then our third drill rig will be drilling some only recently identified silver, zinc, copper, VMS outcrops. We only announced that in January this year. So 3 drill rigs drilling through the season. Our first drill rig will start at Dry Creek, and that'll be drilling before the end of May. So a pretty exciting time for White Rock. What else are we doing? We're in the process of merging, as I mentioned, by acquiring Ozstar Gold, a Victorian gold explorer and producer. It's got a great land package, 670 square kilometres. It is southeast of Fosterville. Many people may have heard of Fosterville, run by Kirkland Lake, one of the world's richest gold mines. It also has a small high-grade producing gold mine in its own right at Morning Star. So a great opportunity for White Rock to acquire a producing asset with a great exploration potential. And we see that as offering good entry into the Victorian gold scene at a good price with great exploration potential and also a small production profile. Not many gold producers in Victoria. Victoria historically has produced over 80 million ounces. So it brings the project closer to home for White Rock. We're based here in the great gold mining centre of Ballarat, and also provides counter-cyclical news flow to our Alaskan assets. So we think a great acquisition for White Rock. We've also got our third project that I mentioned, Mount Carrington. It's had past mining. You walk onto ore. That's the photo on the bottom left. It's got JORC resources for gold and silver. It's got a feasibility study. And we're fortunate to have found a partner in ASX-listed Thomson Resources. So we're joint venturing that. So they will pay to advance the project through environmental steps and also take the study to definitive feasibility study. During that period, they will spend money. They will earn into the asset. White Rock gets free carried, and they will also be looking after the care and maintenance costs and putting funds into the White Rock bank account. So again, for a White Rock investor, it allows us to focus on Alaska and the exciting stage we've got with the 3 drills. It allows us to focus on the acquisition merger with Austar Gold and the Victorian opportunity, all the while advancing our Mount Carrington asset thanks to Thomson Resources. So why should you look at investing in White Rock? Again, I would encourage you to go to our website. You know, we have this really rich zinc silver VMS project in Alaska that we'll be drilling. We've also got this very large gold anomaly in Alaska that we will also be drilling. We've got Mount Carrington being advanced thanks to Thomson Resources. We are in 2 great jurisdictions, both English-speaking, follow the rule of law in Alaska and in New South Wales. And I think for an investor, that's very important. You know, there are places in the world where there are great deposits, but sometimes sovereign risk is an overlay that can get in the way of achieving success. I think being in Alaska and New South Wales is a great advantage. And of course, I'm not the last one and I'm a little bit biased, but our board and management team, mining engineers, geologists, business analysis, M&A, I think is the right suite, both in depth and breadth, to certainly look after and try and add value for White Rock, its shareholders and the funds that we have. And then, as I mentioned, all things going to plan with a scheme booklet and Austar shareholder voting. Hopefully the merger will occur. We'll acquire a Victorian gold explorer and producing asset around July. So look, thanks for that, ladies and gentlemen. You're more than welcome to go to our website. There's lots of information there. There's an @info line if you want to drop us an email, and also through the Wholesale Investor platform if you want to reach out and in contact with me. So thank you very much for your time.
Presenting now is Ensysce, a clinical stage biotech company using its proprietary technology platforms to develop safer prescription drugs. Here to talk further about this opportunity is CEO Dr. Lynn Kirkpatrick.
Thank you to all that have joined us today. It is a pleasure to be able to present to you our exceptional technology that is designed to reduce the economic and social impact of drug abuse and overdose. I am Lynn Kirkpatrick, CEO of Ensysce Biosciences. Ensysce is a clinical stage company with 2 technology platforms to improve safety and reduce abuse and overdose of prescription drugs. Our initial focus has been on addressing the opioid crisis through development of our novel pipeline of clinical candidates. Our first such product, PF614, is expected to launch commercially by 2024. We have dueling crises. We have those suffering from chronic pain daily and those abusing painkillers. Opioids have been used almost since the beginning of time. They provide the most powerful and effective pain relief available today for severe pain. However, their use has spiraled into a crisis here in the US, which has been made worse by COVID-19. Before the pandemic, we were losing 130 Americans per day to opioid-related deaths. Sadly, now that number has risen to over 200. Think about that. It's equivalent to a plane crash every day. And besides The US, there are a number of countries and regions in the world which are having increased rates of opioid abuse and overdose. We believe Ensysce's products are uniquely positioned to address the horrors of this crisis by delinking pain relief efficacy from abuse potential. The primary focus of our lead program is to enter into the enormous chronic pain market with PF614. We believe this market size exceeds $18 billion annually in the US, and it's reported to be over $100 billion globally. Despite the enormous need for pain management treatments, the dearth of effective painkillers for severe pain has impeded the ability of the industry to provide an effective solution outside of opioids. The pharmaceutical industry had sought to utilize abuse deterrent formulations to address the crisis, but that has been unsuccessful. And government restrictions on opioid prescriptions, while mildly successful in reducing abuse, have impeded access to daily opioid medication for those in need. Our technologies have been developed over a number of years and are described by the acronyms TAP, Trypsin Activated Abuse Potential, and MPAR, Multi-Pill Abuse Resistance. We expect that our TAP technology can be applied to almost 75% of all prescription drugs, demonstrating the breadth of applicability of these platforms beyond just opioids. TAP removes the ability of a user to abuse drugs through methods including snorting or inhalation, chewing, or simple kitchen chemistry. TAP applied to opioids prevents a user from achieving the instant euphoria that abusers crave. Additionally, our MPAR technology takes that protection to the next level by decreasing the susceptibility of TAP drug products to overdose. We believe Ensysce's TAP technology platform applied to opioids is the best-in-class solution to opioid abuse. Our TAP opioids are able to provide safe and effective pain relief without the abuse potential. At the right of this slide, I provide a schematic of how it works. After swallowing our medication, a two-step activation process takes place, initiated by trypsin, an enzyme which is only found in the gut and is used to digest our protein. Importantly, we've demonstrated through clinical trials that TAP actually works as designed. Additionally, our technology has been supported by federal agencies. PF614 has received fast track status from the FDA in recognition of the unmet needs facing the US population. And our work has been supported by two large US federal government grants, which are supporting two additional clinical programs. On the next slide, I introduce our lead drug candidate, PF614, which we've designed to replace OxyContin in the market. As seen on this slide, PF614 has a number of metrics where it has outperformed OxyContin. And importantly, and unlike OxyContin, unless PF614 is swallowed, it does not release an opioid and cannot be manipulated to produce instant euphoria. Importantly, our technology platforms are supported by a substantial worldwide patent portfolio. We have laid out a series of milestones that we expect to guide our business operationally over the next 3 years. We know from our previous clinical data that our programs have been substantially de-risked, and we are confident in our ability to achieve regulatory success. Almost every company has a slide like this introducing their outstanding management team. In this case, I want to stress that my team truly does have all the tools in place to make this company a success. Most importantly, a proven track record of launching very challenging drugs, including Nicorette, Prozac, and Seroquel. Ensysce previously announced a business combination where we will merge with a wholly owned subsidiary of Leisure Acquisition Corp, or LACQ. Slide 15 introduces a transaction, and following completion of the merger, we expect the combined company to be on sound financial footing which should position us to progress our clinical stage pipeline and grow Ensysce over the next 3 years. In summary, Ensysce is a clinical stage company with a highly novel approach to provide safer options for those suffering from severe pain. Our programs have been de-risked through phase 1 clinical studies. We have near-term valuation inflection points. We expect our lead program to reach commercialization in 2024. And we have a highly motivated, experienced, and focused management team to make it happen. We are dedicated to saving lives with our new class of agents. Thank you.
Presenting now is Altech Chemicals, who have developed the technology to nanocoat particles of graphite and silicon, typical of those used in lithium-ion batteries. Here to talk further about this opportunity is Managing Director Iggy Tan.
Hello, my name's Iggy Tan. I'm the Managing Director of Altech Chemicals. Altech Chemicals is an Australian company listed on the Australian stock market. I want to talk about the future of lithium-ion batteries and our alumina coating technology. Tesla, I guess, is a vision of where the lithium-ion batteries are heading to. In their recent battery day, they announced something like 3 terawatts of battery factories being built by 2030. That's equivalent to 20 gigafactories. And what's interesting is that Tesla also announced more silicon in their anodes. Now, in case you don't know what a lithium battery is, on a lithium battery, you've got the positive side and the negative side. And when you charge a battery, the lithium ions go across to the anode side. When you discharge a battery, the lithium ion goes back. But what people don't realize is that about 10% of lithium is left on the anode side. And this is called the first cycle lithium loss capacity. So imagine 10% of your lithium is lost to the battery, even the customer gets it. And this is called the SEI coating that forms on the anode particle. And the industry has been trying to resolve this problem for many decades. And there's plenty of literature that shows that alumina coating of the graphite solves this problem. Now, in this animation, you can see a graphite particle and all the lithium ions forming an SEI layer. As I mentioned, all the lithium ions in the SEI layer becomes inactive. And if you look at the performance chart of a battery, you can see this first cycle loss capacity. And as the battery performs at the 80% mark, that essentially is the life of the battery. Now, what's also interesting is that there's hydrofluoric ions in the electrolyte that tends to corrode the SEI layer, and more lithium is absorbed onto the SEI layer. So therefore, there is a degradation of lithium through the life of the battery. Now, there's plenty of research that shows that alumina coatings resolves this problem. And there's many research that shows that it improves the cycling of the battery, it improves the fast charging capability of the battery, and it also prevents thermal runaway. Now, this is an interesting research that shows that they compared coated graphite with uncoated graphite. And you can see there that coated graphite with alumina performs a lot better than an uncoated graphite. This is a very good example of thermal runaway, where coated graphite prevents thermal runaway. So on the left-hand side, a battery is punched with a nail, and the temperature of the battery heads up to 600 degrees, and you have thermal runaway. Where for a coated graphite material, the battery temperature only gets to 90 degrees, preventing thermal runaway. Now, we have technology to coat the graphite particle with alumina coating at 2 nanometers. A very fine layer of coating, and it prevents the lithium from forming an SEI layer, so it makes it available to the battery. And what's interesting is we also find that the alumina absorbs that hydrofluoric ions and turns it into an inert material. So that's also going to be beneficial for the lithium battery. So we can resolve this first cycle loss. This is what the battery performance should look like. The curve extends out, and at the 80% level, you have an extended life of the battery. This is what we have in our laboratories. On the left-hand side is a typical graphite sample without coating, and you can see how continuous the layers are. On the right-hand side are typical what the industry is trying to do, very thick and irregular layers. So in essence, our coatings have very strong advantages. It's simple and easy to commercialize. We have lower costs in operating, and we can adjust the thickness layer. We've gone to battery tests now. Our coated graphite have performed well in our battery tests, and we are in the process of repeating all those tests before we publish the data. In order to support this, we have an MOU with SGL Carbon, one of the largest graphite producers of Europe, and they want us to coat their graphite material with our alumina technology. Now let's talk about silicon, because this is really the future of where lithium batteries are heading to. Silicon has 10 times the capacity of carbon. So in layman's terms, there are 10 times more sites that the lithium can sit on in the silicon structure. So a very promising anode material, but the problem is there are three problems. Firstly, silicon expands at 300%. It has a larger cycle loss. So instead of a 10% first cycle loss, it's probably close to 50% cycle loss. And the third problem is that it has high fade. So if you look at a graph of a silicon material, you can see this massive first cycle drop, and the performance drops off very quickly. So even though you have higher density for this battery, the life of the battery is not extended. And this is an animation of that expansion in volume. Whilst it expands, it also fractures. And when silicon particle fractures on the anode side, you get delamination, which is also another problem for the battery. Now, what's the solution? Well, the industry has already tried alumina coating on silicon, and we have that technology to get it into commercial terms. And our belief is that our alumina layer helps prevent that fracture, which is a very important issue to resolve. Now, we have now coated silicon particles with our alumina in the laboratory, and it's now in battery tests. The performance looks very promising at this stage. So if you look at, if we can resolve the first cycle loss on silicon, this is what the performance should look like. Now you have a double whammy where you can extend the life of the battery, and the density of the battery is also larger. Now, how does that impact on the commercial application? This is the Tesla Model 3, where mostly it's only a very low levels of silicon. It generally travels 423 kilometers on a first charge. Now, if you add 10% silicon in your anodes, it brings it up to 700 kilometers. 20% brings it up to 1,000 kilometers, and 30% brings it up to 1,300 kilometers on a single charge. So you can see the benefit of increasing levels of silicon in the anode, and this is what we're after. We have signed up a collaboration agreement with one of the largest silicon suppliers in the world, Ferroglobe, and they also want us to coat their silicon material with our alumina technology. So we've now launched a pre-feasibility study on a battery materials coating plant in Germany, and it'll treat 10,000 tons of graphite material, and we have commenced that study. We have an option to purchase the land in Saxony, and in the state, there's many electric vehicle plants and battery plants in the state. We believe the future of lithium battery is going to be Europe. I guess Japan, China, and Korea has been about the lithium batteries, but the next phase of the story is essentially around Europe. Europe has announced 600 gigawatts of battery factories to be built, and the reason it's swapping to electric vehicles, it's all about regulations. And if the car companies don't meet those regulations, they're up for billions of dollars in fines. So they don't have any choice to move to the EV industry. Now, if you look at the battery cell capacity around Europe, something like 600 gigawatts of production capacity has been announced for Europe. Companies like CATL, Northvolt, Freyr, and so on. So the future for Altech is a graphite silicon anode But more importantly, we will coat the materials with our alumina technology. So graphite coated with alumina, silicon coated with alumina, and that's our future. We also have a 4,500 tonne per annum high purity alumina project, and I won't go into details of that. You can find that on our website and all the background to that. So thank you very much for your time.
Our next keynote speaker is James Graham, the CEO of Recce Pharmaceuticals. James will be speaking to us about investment value drivers, the value of new medicine, and his investment and founder journey.
Hi, I'm James Graham, CEO of ASX listed Recce Pharmaceuticals Ltd. Thanks to Wholesale Investor Small Cap Conference today, I've been invited to give a presentation on my experience in the world of entrepreneurialism and investing. I quite uniquely sit on both sides of the fence. I actually very much enjoy business, and I thought in that experience, although perhaps not as long as many here, I would talk about where I've come from, where I'm going, and some of the cold, hard truths of radical innovation and what I believe to be the opportunity of new medicine. So where have I come from? One of my first early stage experiences, of course, was really in the cold, hard face of angel investment. I was a committee member of the WA Business Angels, which is the earliest hope and a dream stage, if I call it, fundamental of investing. We, day in, day out, would be approached by wonderful technologies, passionate, if I call it, sometimes quite eclectic entrepreneurs across a large range of industries, of backgrounds, of ages, and of course of geographic market opportunities. In that experience, I invested in probably half a dozen or so companies, obviously all private stage. Some have worked out, some haven't. In fact, I'd say the ones that haven't have been the most valuable lessons overall. At the same time, and during that experience, we co-founded QuickBoats. QuickBoats was a folding boat technology company. It won many awards. We raised many millions of dollars for it. WA Innovator of the Year finalists, and you can look up the videos and bits and pieces in the background. But really what we did there is we looked to a challenged market model, and we sought to break that fundamental challenge of one of those industries, which is you got a good boat, you've only got as far as you can tow it, or as far as you can tow in regards to selling it as your local market. This was really unpacking that market challenge of distribution. So a pick and pack model, where of course a flat pack boat where you could tow the caravan, have it on the roof, store it in your garage, and distribute all around the world as around 40 of them in a sea container, really changed that broken paradigm of the boating industry. So as a company, it was successful across the many different metrics that one would consider success. We sold the company in around 2016, and around that stage of liquidity, which was a private sale as opposed to the many other stages we'll discuss, I utilised some of that capital to create or to be the first investor. I didn't create the technology, but the first investor in Recce Pharmaceuticals Ltd. So in around that time, I met Dr. Graham Melrose, who was retired at the time. He had previously been head of Johnson & Johnson Research of Australasia of a decade. His experience was in polymeric chemistry, so really designing compounds with the end in mind and matching good products to major unmet medical need. Dr. Melrose actually had a previous company, which was the highest growth stock on the ASX each year for 3 years running. He retired when it was approximately $1 billion in valuation. And some 3 years after his retirement, the management at that time blew the company up. They completely changed the business model, which I believe to be the fundamental key to any good business, and the company went bust. So knowing Dr. Graham Melrose in the background, knowing what had really occurred there and his passion to challenge the broken business model of antibiotics, the challenge of antibiotic resistance, and the ability to, of course, create technology to match that unmet medical need. I supported Graham from both an investment side, but also a working alongside side. It's wrong to take or departmentalize in early stage, one role or another. I think everybody rolls their sleeves up, gets in there and gives it a go. So that was my early stage. I'm now the CEO of that company. I'm not technically a venture capitalist. I invest mostly for financial interest, yes, but really just something fun to do. I like business, and getting a stake in the game as an investment allows is something good fun for anyone. Now, as the CEO, we are an S&P ASX All Ords 500 company, meaning we're top 500 most valuable on the ASX. We're one of the best companies in regards to capital return on the ASX. We are a world leader in synthetic anti-infectives, and I work with an amazing team. I was only just the other day with Professor Fiona Wood in Perth. The privilege of what technology can bring can not only be, of course, financial return, but a wonderful life experience for all involved. So when we look at, or at least when I look at investments, there's, of course, the good book theory. Everybody loves theory. And here we talk about some of that theory, which I believe to be true. But I thought I'd also introduce, just with a grain of salt, a few cold, hard facts as to my experiences around such theory. For avoidance of doubt, this is not investment advice. This is just in my personal experience. So really, when assessing an opportunity, I look to it as a game of upside opportunity versus downside risk. Your downside risk is losing your money. Upside, or potentially being sued. Your upside is how many multiples of it can you get back, if ever. Fundamental behind it all is a unique technology. A Me Too product, you're only going to win by margin. It's otherwise extremely difficult. You've got to have a competitive advantage. The business model is fundamentally important. Business models essentially meaning margin when it gets through the distribution chain, direct to market, direct to consumer, distribution, so on and so forth. Intellectual property, a lot of emphasis on intellectual property depending on the various industries. In my background in pharmaceuticals, it is fundamental. It is the asset that has a transferable value. In some other industries, you can have a fantastically profitable business without any real intellectual property at all. And there's nothing wrong with that. It's just the nature of the industry. Deal terms is a suggestion of get the best price, best entry price. Lower the better is, of course, the insinuation there. As you'll see further in, I found in practice that not the best advice for all involved. Management history of success. Everybody likes to look at the management and go, oh, they've done it before, they can surely do it again. I'm a little skeptical as to that view. I think, once burnt as one can be through a failing is sometimes a lot less likely to make that same mistake again. Be conscious of future funding rounds. When I invest in an early stage, whatever it may be, I've often got a follow-on amount in my mind that I'll generally participate in. Anybody's dreaming to think that there won't be a future round. There almost always is. Independent valuation. For the lazy investor, some kind of external expert to tell them why the lay of the land, why this product could be very useful or similar is always good. Particularly enter as many competitions as you can. I found them to be inexpensive, if in fact generally free, and a wonderful market leverage opportunity. To be a finalist or to be a winner, everybody loves that. Bootstrap or an investor ride. Some people will come up with glorious ideas and expect you to pay for it. I don't think it's worth paying for anything if they won't pay for it themselves. Exits, typical trade sale, IPO or following round sell down. That's what one would normally look for. They're all good in theory. They're not so easy in practice. So just a couple of cold hard facts. It will take twice as long and it will cost twice as much. It's just a fact. There's nothing wrong with that. The entrepreneur will say it won't. Best endeavor basis, of course. The investor will always find it will. So just be conscious of that with your following rounds. Deal terms, as I said, paying lower is not always better. If you squeeze too much equity from the entrepreneur as the time comes to commercialization and things get tough, they'll do their value to opportunity and go, it's not worth my time, and they'll shut the thing down. Intellectual property, everyone's got a patent pending. Ask, is it granted or is it pending? And really assess whether it has opportunity to grant, because pending means nothing. The business model is fundamentally key. Ultimately, the entrepreneur will make something up. Don't expect them to actually know at the stage of asking such. It's all a best endeavour basis, but just have a gut feel as to whether there is such a business model available in due course. Independent valuation. If the valuer or if the person such as Professor so-and-so, an expert in whatever it is, if they knew anything about anything, they'd probably be doing it. Generally, they don't. They just talk about it. So either they are from a position of factual naivety when it comes to commercialization of such, or there's some kind of vested interest in the background. As I mentioned earlier, management outstanding history of success. Statistically, the bigger the risk, the greater the opportunity. If anybody's taken a big risk and actually achieved anything, they probably have failed. And that's actually a good thing, because there'll be some lessons that come from such. And I'd much rather back a failed loser. By example, Andrew Twiggy Forrest originally fell on his face in a very big way. Now he runs one of the most successful companies in the country, which was his very next venture, built upon the lessons he learned in the previous. I think that's an important part. Unique technology. The more unique, the more radical the innovation, the bigger the hurdles to market, more regulatory pressure, more lessons in manufacturing, more consumer considerations as to value and early adopter take-up. It will just cost a lot more money, but it can also create a position of margin if done correctly. Don't be surprised if you get it wrong. It is hard. Future funding rounds, everybody will yell they'll get a grant. Very, very few get grants. Grants, in my experience, are generally reserved for disguised government spending. It's a cold, hard fact. I'd instead, rather than look to grants, consider what opportunities are available in diluting costs by way of R&D rebates. They're 43.5% backed from each dollar, very valuable to the company. I mentioned bootstrapping as key. And exits. I've got a lot of money in a lot of different things. On the books, it looks great. I couldn't get $1 from it if I wanted it tomorrow. You think of an IPO, you'll probably get a haircut going for the IPO itself, but you hope to make it up soon after the entry. You'll probably get escrowed for 12 to 24 months anyway when the hot air comes out of it, so you're kind of a little stuffed there too. Essentially, eyes wide open is the moral of the story here. Investing is a wonderful exercise. You get to work with great entrepreneurs and vice versa. And I do it regularly, but do it with your eyes wide open. And of course, you may just get the best outcome. So where that brings me, of course, is the opportunity I am part of now. And I have the privilege of leading Recce Pharmaceuticals, which is an ASX-listed company. We recently dual-listed on the Frankfurt Stock Exchange. And we are commercializing a new class of anti-infectives. Anti-infectives being antibiotics and antivirals sitting under the umbrella of such. We have a qualified infectious disease designation awarded by the US FDA. Independent market verification, very, very key. But what that really means, of course, is a 10-year market exclusivity above and beyond, another market validation and de-risking opportunity. We've established our manufacturing, we've got a whole lot of money, and we're delivering on our commercialization journey. Why Recce? What do I like about it? If I say it, antibiotics are flawed. The business model is bust. The people are offering a Ford, expecting a Porsche price, being the hospitals prepared to pay for such. No one will do it. So why do I find this area interesting, and why did I initially invest? Well, really, everybody in the space has been doing the same thing, expecting a different outcome. 1 + 1 does not equal 3. So Big Pharma has essentially gone, we're not inventive enough. We'll let the little companies do it, and we'll either acquire or license the technology as it comes to market. Stage of liquidity. The fundamental challenge of why the antibiotics are not valued as well is they don't do what they used to do. Gone are the days where you'd get, prescribed one antibiotic, take that and you'll get better. Now you get prescribed the same antibiotic and you've got to keep taking it to get the therapy that you so sought. The product no longer works. So the ineffective antibiotics is because of the mechanism of action that they no longer have. With a good product that has a unique mechanism of action that's able to work today and keep on working with repeated use is something that's very valuable, both, of course, to the patient and the health practitioner. So the ability to, of course, some of the market problems in our space is not form superbugs. Superbugs, what's good today, you use a few times, is no longer good tomorrow. Our mechanism of action doesn't fall to that. Key risk mitigator and upside opportunity. Broad spectrum capability. Yeah, lots of different types of bacterial types and antivirals and similar. What's important, of course, is we focus only on unmet medical needs. And the reason we do that is because it's essentially market monopolies. Unmet, meaning no product currently available. Significant patient population, of course, slight monopolies. And that, of course, is a key value driver. Ultimately, it's a balance of good for the consumer. Does it overcome the challenge that they're seeking? Good for the practitioner. Does it achieve what they're so seeking? Is it pharmacoeconomically reducing a challenge and threat? And of course, most importantly, will it have a future over a period of time? And in our case, the answer we believe to be yes. So I take it some background from Paul Kelly, of course, from little things, big things grow. And it takes time. Time value of money is key, yes, but if you fundamentally believe in the technology, you can stick with it and take advantage of sometimes of those lower valuations. Without giving away my entry point, we'll just consider from IPO stage of around 20 cents, trading currently at about $1.11. It's about a 470% increase, or a near on annualized annual percent of return, 100% of return. This is a good example of one of our upcoming studies. It's a phase 1 intravascular study. It's focused on sepsis, septicemia, or blood poisoning, which is the number one most expensive condition treated in health, double the second most expensive. Why do we point to Pew Charitable Trusts rather than us say it? An independent verification. But really for us, we're flattered because, of course, they say, as we've always said, we're the only drug for sepsis in the world, and we are the only synthetic antibiotic, which is an incredibly powerful and valuable position to be in. Investing versus entrepreneurialism. Both of them give you a little bit of access to great things. My privilege in recent times is working alongside smart people. I've got them all around me. I'm not the inventor. I don't have the science background, but the fundamental of good commerce remains the same. And here, Professor Fiona Wood, who's the former Australian of the Year and world leader in burn experts. She's utilising our compound on her vulnerable burns patient population in Western Australia as we speak. I get the privilege, of course, to lead these 2 clinical programs, which, if successful, can have real-world clinical insights as a sign of things to come in the fight against antibiotic resistance or superbugs. So as a fundamental, I really encourage to approach investment and entrepreneurialism with eyes wide open. It's okay to say no, but it's also very exciting to say yes and to participate in the many wonderful innovations and opportunities that exist in Australia and beyond. Thank you for listening. I've very much enjoyed sharing my experiences, and I look forward to you joining us over the time ahead.
Up next is our panel session for this event, titled Momentum vs. Value Investing, What Wins in 2021? Our panelists include Rob Hay, the Head of Distribution and Investor Relations at Collins Street Management, Justus Hammer, CEO of Paws, John Diddams, the Principal and Non-Executive Director of JFDCPA, Lelde Smits, founder of the Capital Network, and Ron Shamgar, Head of Australian Equities at Tamim Asset Management.
Hello and welcome to Wholesale Investor's Small Cap 2021 conference, where today on our panel, we will be discussing momentum versus value investing and what wins in 2021. We have some incredible insights today from Ron, Justus, John and Robert. And I think to kickstart, let's hear from you, Ron. What does momentum versus value investing mean to you and how does it apply to what you do every day?
Yeah, sure. Thanks for having me. Look, value investing versus momentum, I think everyone has a bit of a different view of what it means to them. For us, value investing relies on, looking at company fundamentals mostly and, using financial metrics of a business like profits and cash flow and different balance sheet metrics to value a business. So, metrics such as return on equity, return on invested capital, the asset base and so on. And, these businesses usually priced on relatively low multiples or valuations, a PE multiple or an EV to EBITDA multiple. I think that it takes into account, I think value investors maybe don't look as much at sort of industry tailwinds or disruption to the sector. They're more focused on those fundamental elements of what makes a stock cheap or undervalued. And to us, momentum investing is more looking at a big picture thematic. So, looking at thematic that is currently growing. So usually companies that are, disrupting an industry or, doing a lot of innovation. So could be technology and so on. And then, these are businesses that usually have a really sort of fast growing revenue base and they're scaling quite quickly, but they also tend to make losses and burn lots of cash and raise equity quite often. And so the valuations in this sector, are more based on, say, a revenue multiple. And then usually the market leader in that sector is considered the benchmark for actual valuations for others in the sector as well. So, I think that that's sort of the difference that we see between the two. And we actually think that investors should use both.
Sure thing. Well, Ron, you are, of course, the head of Australian equities at Tamim Asset Management. And we also have Rob here, who is the head of distribution and investor relations at Collins Street Asset Management. I'm keen to hear from what Ron said. How do you agree or disagree? And what is your approach at Collins Street Asset Management?
I agree with most of what Ron has said. At Collins Street Value Fund, we're deep value contrarian investors. And we focus on absolute returns rather than returns which are relative to a benchmark or an index or something like that. As the old saying goes, you can't eat relative returns. And so for our investors, preserving capital and growing their wealth in real terms is what matters. So for that reason, when we look at companies, we look at a lot of the same types of metrics that Ron said. We look for companies with low price to earnings multiples. We look at companies with low debt to equity and the like. But what's really key is that we spend a lot of time in the field getting to know management, the board, customers, suppliers and the like, so that we can arrive at an intrinsic value for the stocks that we're investing in, which we can have a high degree of confidence in. Anything that falls outside of this, particularly with the realm of momentum investing, starts bordering more and increasingly encroaching upon the realm of gambling and the role of speculation. It really requires a belief that something continues to go on, and invariably results in a game of greater fool, where you require someone in the future to pay more than what you pay today, based on no change in valuation or fundamentals. So we tend to focus strictly on the financials, really get to understand an idea, rather than gamble away with clients' money.
Sure thing. And John, I saw you nod your head there, but how is this different or similar to your approach? And perhaps if you can start by outlining what it is that you do.
Yeah, thanks, Little. Yeah, I've been running my own business for about 30 odd years now, helping the companies to list on the ASX. So I joined the company as a director and then helped them through the process, managed the lawyers and accountants and everybody else and the capital structure, introduced them to the brokers, helped them to to raise capital, and then help them to list. And then I generally stay on for a couple of years to help them through the transition from private to public, because it's quite a big change for a lot of people. And the whole operation is because if the CEO tries to run the process of doing an IPO, A, they take their eye off the ball in terms of the business, and the CFO as well to some extent, and B, they've never done it before, so they fall into all the old traps. I've done 25 or 30 floats, so I've pretty well seen most of the traps. I won't say you find a new one every time, but at least we can deal with them. So that's what I do. How do I look at a company that comes to me and asks me to help them? I tend not to worry whether they're momentum investing or value investing. It could be either, could be both, could be neither. What I tend to look for more is who are the people. It's very much like Robert said. They must be passionate and have integrity and intelligence and energy, ethics, and so on. But I also look at the unique selling proposition. Where does that? What is that? And does it meet a demonstrable need? It's not just we'll build it and they'll come. That's had it. And then the next you look at the total addressable market of a business to see whether in fact there's worthwhile. Must be easily identifiable. But is it worth doing, or is it a tiny market? And then you look at other things like the IP protection and the business model. Is it easy to understand? You've all heard the term the elevator pitch. Well, that's very important. If you can't explain what your business is about in a few floors, then give it away. And then obviously on that, if you might be able to explain your business plan, but you've got to be able to execute on it too. So you need good people to be able to do that and so on, and obviously need the money that you raise. And then lastly, probably not least, is good governance. I'm a great stickler for having governance within an organisation, and I help private companies put the governance in place. So those are the sort of things I look for in a business, and whether they're momentum or not, I tend not to go with momentum investing. I think momentum investing is just a fad right now, because there's a lot of people that are making revenue or making eyeballs, as we used to call it back in 2000. I guess from my point of view, cash is probably more important than all of those things. An old colleague or an ex-boss of mine that ran the whole of the outfit I was working for in London about 30 or 40 years ago told me that a good business is one where more money comes in than goes out. And I've never forgotten that. So I think that's where I stand on these things. I think it can be either.
Sure thing. Now, among everything you said, you did mention the elevator pitch, and we only have one ASX CEO on our panel today, and it is Justus, who has just recently listed Paws on the Australian Securities Exchange. I'm keen to hear your elevator pitch for your company, and then perhaps when you introduce who Paws is and what you do, if you can also tell us what response investors had to Paws in the lead up to your IPO, and following your IPO, what investors do you believe are most attracted to your company?
Thanks for having me. So, yeah, the elevator pitch is quite easy. We're Australia's leading pet service marketplace. So, there's a lot of pet owners out there, and through COVID, you can imagine there's a lot more out there. I think most people know somebody or have themselves gotten pets over the last 12 months. And so if you need somebody to look after your pet, you're going on a holiday, so you need to go back to work, you can go onto madpaws.com.au and you'll find a local sitter to look after your pet either at your own place or at the pet sitter's place. And we've been doing this for now 5 years plus. And like I said, are the number one player in the space. And we recently also launched an additional revenue stream, which is Dinner Bowl, which is a pet food subscription service, which delivers pet food straight to your doorstep. And so the experience in terms of getting listed on the ASX, we had our listing just about 4 or 5 weeks ago now. It's obviously a very exciting moment for the company. We're I think in a very good position to kind of benefit from the tailwinds that we're seeing from COVID. There's numbers now in the US, that pet ownership has grown by over 20% in the US. There's no official numbers yet in Australia, but we expect very similar numbers to see here. And on the back of that, I think the interest in Madcourse for the IPO was phenomenal for us. We raised $12 million in the IPO and $5.5 million in the pre-IPO, which puts us in a position now to execute on the strategy that we have to benefit of those tailwinds.
Okay, and I think it's terrific that we do have you on as an ASX listed CEO here on the panel. Ron, when it comes to other ASX listed companies, could you give us perhaps some examples of what you'd consider momentum investments or value investments? And if your clients are asking you, how do I diversify, and perhaps get a bit of both, what your recommendations are to them?
So I think a really good example of momentum investing, over the last sort of 12 months or maybe a few years as well, has been the emerging sort of thematic and the sector of the buy now, pay later. So that's a classic example, of a new and emerging industry and a service that really is sort of replacing the traditional credit cards. More appealing to a younger generation that, don't want to use credit cards. They want to use this budgeting tool of installment payments. And obviously we've had sort of the emerging leader like Afterpay emerge and take market share, and then others followed like Zip and Sezzle and so on, and many others. And I think that's a classic example where, the value investors and, they would not invest in companies like that because they were all loss making and burning cash and very hard to justify buying these businesses. But, these businesses were disrupting a big industry that has a huge runway, and they were growing quite fast. The revenues were scaling really quickly, as I mentioned before. And then investors that took a big picture view of things and, said, well, if this can continue and these businesses can take a certain market share from, for example, from the credit card market industry in 5 or 10 years from now, then there will be much bigger companies. And so we've seen that actually evolve, and companies like Afterpay and the like, they've succeeded in taking huge share and they're still growing, and we've seen the valuations and the returns to those investors who back this so-called momentum investing in that sector do really well. We obviously did benefit from that sector. We did invest in Sezzle last year at under $2, and we took it all the way to $10, and we did sell out. So that's one, for example. And obviously, there's always going to be sort of new industries and new thematics that emerge that play into momentum investing. I think at the moment, there's a bit of a transition away from some of these momentum thematics, and the tech sector and the buy now, pay later, they've had their run. And I guess investors need to look for what's next. And then examples of value investing, well, to us, that's more, undervalued, profitable business that are experiencing tailwinds. So for example, the auto sector, the second used car vehicle market after market for parts, that's doing really well with COVID and international border closures. We're seeing Australians take to the road. They're avoiding using public transport. They're obviously holidaying domestically, so they're using their cars more. So companies that are really cheap and screen really well on all the sort of value investing type metrics. Two companies that we like is National Tire and Wheels, and RPM Automotive, both supply car parts, wheels, tires, and so on, mechanical repair shops in the sector, and both are trading on very low PE multiples, are profitable, are growing, cashed up. And that's just kind of examples of companies in both sectors.
Thank you, Ron. That's very, very, very interesting. And Robert, when it comes to your views and perhaps some examples of value and momentum investing, what have you really seen in the market, and what feedback are you getting from clients in terms of where they're looking for value, and what has taken your interest?
A lot of our clients are private investors, people who have run businesses in their own way and take a very pragmatic approach to how they're assessing a company. And so for that reason, the buy now, pay later space, which is one Ron discussed before, for our clients just has too much in the way of hopes and dreams baked into it. When you're seeing companies trading on a price to earnings multiple, or even more frequently now being quoted on price to sales multiples, But if we just go back to price to earnings, sometimes well over 100 times, not what they're expected to earn this year, but in future years, is just a bridge too far. And put back another way, I'd ask the business owners in the audience to this session to ask themselves, if someone came to them looking for a job and tried to negotiate a pay packet, a salary, that was 200 times the amount of revenue they were going to bring into that business. Not today, but in 2 years' time. Would they get the job? I'll throw it out there as an open question.
Once again, I think John agrees with you. What are your views on this? And could you give us some examples, perhaps, of momentum or investing stocks that you think might be a good pick or ones to avoid?
Oh, no. No, look, I'm not into, sort of picking and recommending and stocks, but I will say, I'm probably older than most of you put together. I've been around, I don't know if everyone's aware, but since the turn of the century, there have been 31 stock market crashes. People only remember the really good ones. I remember 1987 very, very well. And I can tell you, in 1987, all the stocks that you would today have put into the momentum basket all went completely to zero. And those that were fundamentals held their value reasonably well and came out of that downturn. That was a massive plunge. I mean, that was 20% in a day. I can recall stockbrokers and investors jumping out of city building windows. And I kid you not, I did see one. And since then, we've had the dot-com bust. We've had September 11. I went on Google and had a look at them all. We had the financial crisis, the flash crash when the Dow dropped 1,000 points in a day, the China crash, the cryptocurrency crash. And don't forget that there was a period where Bitcoin peaked on the 17th of December and then dropped 42% by the 22nd of December. I count Bitcoin as very much a momentum thing. And then, of course, the COVID pandemic. That was a pretty severe crash. Dropped 34% on a day in February, and it's come out since then. So I always look at investments from the point of view of hope for the best, but plan for the worst, and expect there to be a crash around the corner. And if that's the case, would I rather have my superannuation fund invested in Afterpay or perhaps Combank?
National Tire and Wheels are a great stock as well.
What's that?
I said National Tire and Wheels are a great stock there as well.
Yeah. So that's my view. I guess I'm a bit risk averse, probably because of my age, but also because of my experience in seeing these things happen over many, many years. And the companies that I invest in today are the companies that I help to float. And I do a lot of homework. I work for 3, 4, 5 months with companies before I agree to join them and do this process. So by then I know them inside out, and they've ticked all the boxes that I mentioned earlier, and that way I take them forward. But whether they're, I have done plenty of what you would call momentum stocks. I listed companies that had no revenue at all, like indoor skydiving tunnel. And I've listed other companies that had nothing more than a device for snoring and sleep apnea. That was Somnomed back some number of years ago. That's still playing out today. But they've changed the business model 2 or 3 times to fit the circumstances. So I guess I'm probably not a great advocate for momentum stocks as much as I am for value stocks. And I think that's where I sit.
Okay, and Justus, from your perspective, as we mentioned, you've just listed your company on the ASX. Would you say that a Mad Paws is more attractive to a momentum or a value investor? And how are you trying to position the company to attract your ideal investor?
Yeah, very good question. I mean, I think it's very, it's very much a definition question on kind of what you call momentum and what you call value. I mean, I'd definitely say, successful investors are probably going to look in at both and find the right balance, right? So I think that's the first thing. You want to have something in your portfolio that has the potential of growing, significantly more than paying your 5% dividend and making a couple of percent over the years. And on the other hand, again, like the balance is probably the right thing to look at here, right? So from a MadPaws perspective, we're definitely thinking of ourselves not as a momentum stock in the traditional sense. I think we've got very good fundamentals and very good growth for the company to show for, and particularly in the industry that we're in. We see some very, like we've had continuous growth over the last couple of years, and we see that kind of going forward. So, again, it comes down to a little bit in terms of definition and what you call momentum and what you call value. We obviously see a lot of value in MadPaws. Sorry. And I myself, I'm an entrepreneur, so I normally back myself more than anything else. And so for us, what we look at, and also for me personally, what I look at is always, the combination of the opportunity and the risk that you take. And so, we're working on this business because we believe it's going to be a huge business. We've started this business, 5-6 years ago with exactly those intentions of what we're executing now. And that's the opportunity that we see then in terms of the growth of the business, which has been very much focused on services. Now kind of using the customer base that we've built with over 100,000 paying customers on the platform now to extend that into additional revenue streams. And so, for me personally, when I look at investments, I'm come from the private sector. I've very much kind of in tech investments and startups. That's kind of what I grew up with over the last kind of 15, 20 years. And so it's very hard to say that I'm a value investor, right? Because most of the companies that I've invested in lost money for the beginning of their journey. But the successful ones were always, 10 times plus return companies. So, that's kind of what I invest in, is really the opportunity and the people that run the business. And obviously, I back myself and the business that I run, and I back teams and in the other businesses that I invest in. And so, from that perspective, I think from a private market perspective, you definitely see a little bit of a change there as well, where I believe it was really very much about value investing over, the last couple of years. Now you see a lot more kind of competition also in the private sector, where PEs and VCs come in and pay valuations that are probably a little bit, ahead of where the companies are at. But sometimes you have to do it if you believe that the company is there and the opportunity is there. So, again, it's a little bit of a definition, but certainly we see value, obviously, in what we do and in the business that we build.
Absolutely. I must say, on a personal note, when you listed, I was so interested, and I thought this makes sense to me right now, because it reminded me of a friend of mine in Melbourne who was desperate to buy an animal, a pet, last year during lockdown. And at the beginning of Melbourne's lockdown, they were looking around for a pet, and it was a few $100s to buy one. And by the end of Melbourne's lockdown, it was thousands of dollars to buy a pet. Yeah. And then when I saw that you listed, I thought, wow, it makes sense for this to happen right now. Yeah. And I suppose while we're talking about COVID, we've really barely seen the other side of COVID and its implications. And I'm keen to hear from you, Ron. Have you seen... I'm sure you have seen opportunities. What opportunities have you seen really with COVID in terms of momentum and value investing? And looking forward, how do you think your investment thesis may evolve as a result of COVID?
Yeah, sure. Look, so, obviously last year, we had the sort of March lockdowns and, the market's tanking, and we really kind of took a pause and really tried to understand sort of in April and who are going to be the winners and losers of lockdowns. And obviously we sort of realized quite quickly that the COVID winners that we called, and we sort of, by talking to management teams and understanding what was going on, we could see who could benefit and not. And so we, obviously the COVID winners back then were e-commerce companies, people shopping online, locked down at home. Retail businesses generally as well did quite well. Payments companies, so obviously electronic payments, buy now, pay later, as people were shopping online or trying to avoid the use of cash. They were the COVID winners. the whole work from home and remote working environment. So there were many technology companies providing software solutions for remote working. So they were big winners. And obviously telco businesses, having those solutions and faster connections and all kinds of, business products in the telecommunication sector to enable companies to manage their workforce. So they were the COVID winners. And then, as we sort of, came out late last year from lockdown, especially in Australia, and we're seeing that happen more, say, in the US now and the UK, they've had a large part of their population vaccinated. So everything is reopening again. And we're seeing the sort of COVID winners becoming a bit of losers, some of them, especially in that e-commerce space, for example, where people are spending more time out, they're shopping less online. And so the winners for us at the moment are the so-called vaccine winners. So as I mentioned before, with more sort of domestic travel, for Australians and in other countries as well, the whole auto sector is doing really well. So both companies supplying parts, selling cars as well. We've seen a lot of supply shortages for new cars and so on. So the second-hand car vehicle market has done really well. And then companies that are providing sort of finance for used vehicles, such as, for example, Money3 and the like, are doing really well. And just generally, I think consumers are pretty cashed up and they want to spend the money that they've been given from the government or that they haven't spent in the last 12 months. So we're seeing sort of a retail sector, but more the sort of bricks and mortar now, rather than the e-commerce, doing really well. People are shopping, they're going out, they're traveling, they're holidaying, but they can't spend that money overseas, so they're spending it here locally. So those are the sort of winners that we're seeing at the moment. And I think as international travel resumes for us Australians at some point, then I think you'll see some other stocks benefit as well. Maybe obviously the obvious ones like the overseas holiday booking, flight travels of the world, the Webjets, but they're already priced in. So maybe companies that provide foreign exchange solutions for travelers, like Oz Forex, for example, that we like and is very profitable, and so on. So that's sort of how we kind of changed our approach from COVID winners to vaccine winners.
Okay. And Robert, obviously COVID impacted everyone. How did it impact your investment thesis? And how do you anticipate perhaps your approach to momentum or value investing may evolve as a result of COVID?
Coming into the COVID crisis, the Collins Street Value Fund had 35% of its portfolio value in cash. And that's one of the wonderful things about having a flexible investment mandate. You don't have to do things to all people all the time. And it's not that we predicted COVID or pandemics or anything else like that. Far from it. But we'd taken a view very early on in the game that the average Australian consumer had too much debt in their balance sheet and that the share market overall was quite expensive. So whilst it's going to be very difficult to identify the precise straw that's going to break a camel's back, it's not all that hard to find a tired and weary camel. And that's how we felt the market was looking coming into 2020. So during the depths of COVID, we were able to deploy our capital into a range of companies to actually increase our exposure to some names that we like and assist in the recapitalisation of some companies who had good business models, but perhaps had former management teams that hadn't steered them in the right direction and the like. One company, which I've mentioned before and which we agree with Ron, is National Tyre and Wheel. This is a company which we did quite a lot of research on throughout COVID to try and understand if the consumers weren't going back buying more tyres and the like. But as it turned out, rather than buying new cars and so forth, consumers were spending more money upgrading their existing cars. And so there's quite a lot of bottom-up research we could do with tyre franchisees to get some perspective on that, but also cross-match that with other data around what people use to also upgrade their cars, be it through various accessories, parts, window tinting and the like. The other thing which was quite strong and positive about National Tyre and Wheel is the diversity of their client base. Yes, they have the off-road vehicles and the like, but they have agricultural transport vehicles, those sorts of things as well. And so where different parts of the economy can move at different rates, they can participate in that. So how did our investment thesis change as a result of COVID? It didn't change, I wouldn't have thought at all. Our focus is really to identify the absolute best investment ideas we can. And for that reason, we hold a very concentrated portfolio of 8 to 20 stocks, and to focus on those companies which can withstand impacts such as COVID, or can withstand things. Before that was after that was the US election. And so a lot of people are holding off and concerned with this impact stock or whatever. We're looking for quality management teams backed by strong balance sheets that can see things through. And where we can find those ideas, we'll absolutely back them with conviction. And that's something that we continue to do in fund. And there have been some companies which you asked before, Lelde, about the winners. What I would add to Rob's point before is that we saw a lot of the JB Hi-Fis, the Nick Scali's, being winners as well, as people were spending more time working from home. So JB Hi-Fi does well. Nick Scali, people were looking at their furniture around their home, and naturally this goes quite well. But I would ask anybody who's tried to buy a new couch or a TV or those sorts of things of late, what their experience has actually been. And we're seeing that now a lot of that backlog of inventory is being expired and exhausted. And there are now actually significant delays in terms of getting a lot of this stock through to the consumer. And so what was a tailwind for a lot of these companies through COVID is now actually starting to hang as a cloud over them. So for us, we continue to maintain conviction in our portfolio. We've got some companies which have very little rhyme or reason to the Australian market, such as ASX-listed uranium stocks, which continue to perform quite strongly for us and are largely uncorrelated. Again, providing a tailwind to returns throughout 2020 and certainly through 2021.
Some very interesting insights there. And John, I'm keen to understand from your perspective how COVID impacted your views and approach to investing. And looking ahead, we've certainly already heard some summaries of the winners of COVID. Looking ahead, which sectors do you think are really poised to do well? And how would you be approaching investing when it comes to momentum and value investing amid this period, which is still a period really of COVID and emerging from COVID?
Yeah, thanks, Lil. Yeah, what's really quite interesting is that my view there's quite a lot happening in the healthcare space. There have been a number of companies that have come up and doing the healthcare online and so on, and they've done quite well. I'm director of a company called Volpara, and Volpara is into analysis of mammograms to detect breast cancer. And in the early stages of most of our 90% of our business is in the United States, and in the early stages of COVID, all the clinics shut down and stopped doing mammograms. Within 2 months, they started up again because women were demanding they needed to have their mammograms, and breast cancer wasn't going to go away just because of COVID. So those clinics started up, and we are now seeing almost twice as many mammograms now per month than pre-COVID. And as a result, we're now analysing far more of those. In fact, Volpara now touches 30-something% of the US market of women with one or other of its products. And we've diversified that business from simply analysing mammograms to helping clinics manage their business and also helping them to report their business to the FDA and others. So it's a very sticky product. We're in the largest hospitals in the United States. And the recurring revenue that comes from it, we also switched from a one-off sale of capital items to a recurring revenue model, which 3 or 4 years ago meant that we had to take a downturn in revenue to implement that new system. But now we've now got, I think, nearly 90% of our revenue is recurring revenue. So they're contracts that everybody pays every month and so on and so forth. And so it's gone incredibly well in the last 6 months. In fact, the last quarter just had our best quarter ever. And that's coming out of COVID. And people are now seeing that these things like cancer don't go away and they need to be treated. So I see that. I'm also director of another company out of New Zealand called Arawa. ARX is the code, and that's in wound healing. And whilst elective surgery also fell off a cliff in that March-April period last year, it's now come back and is now going even stronger than ever. We've had much stronger sales in America, and the company's doing really well. Interestingly, both of those companies, you could almost call them momentum investing companies, because we've taken the view that rather than pushing towards cash flow break even and profitability, that we're better in those instances to obtain market share. And we're now spending every dollar that comes in on grabbing more market share, and we're now the leading, Volpara is the dominant player in breast health in the United States, other than the large equipment manufacturers. That is a different model, different make. So we have taken that longer term view, and that's paying off because we're now owning a lot more of the space, but we're providing a product that everybody wants. So it's good from that point of view. So I see healthcare as being a major area to invest in the future, because as soon as people can get all these COVID people out of the ICU, there's a whole bank up of people ready to go in there for their elective surgeries and other things. So that's where I'd be putting a lot of money.
Absolutely. That's a very...
Not that I'm an investment advisor. I'd take my hat off to Robert and Ron on that basis.
But it's certainly a sector that you like.
Yeah, very much.
And another theme of COVID and COVID investing was that we really have seen a resurgence of IPOs on the ASX. And again, Justus, coming back to your ASX IPO, I'm keen to hear what made you list on ASX right now, how you felt the investor appetite was towards Mad Paws in the lead up to your IPO. And given COVID, how do you expect that your business may have to adapt in the future, or is it already positioned to really take advantage of many of the new trends we're seeing as a result of COVID?
Yeah, a very good question. I mean, COVID obviously impacted us, being closely related to travel. We saw a dip first in our revenues at the beginning of COVID. But as I mentioned before, after the initial shock of what kind of happened, we kind of realized that really long-term COVID is a huge tailwind for us. And, the guys have been talking about, particular sectors that might be benefiting from COVID or have benefited from COVID. Like we, not quite surprisingly, but are truly believers in the pet space in terms of long-term winners of the COVID effect. Because if you think about it, whether it's payment services, subscription services, or anything like that, a lot of those services customers might cancel once COVID. We return to normality after COVID, but once you've got a pet, you're stuck with it for 10 years, and that's great because people love their pets and people are treating their pets more and more like their own family. And that's really kind of what we've seen throughout the time of the pre-IPO and IPO, that investors are really interested in that thematic. People have seen it. It's kind of very easy to touch and feel for people, talking to neighbors and people in the street to see how many people have actually gotten pets in the last couple of months. And so from a thematic point of view, I think we were just in the right space. And I think that's why we had a great demand for the pre-IPO and IPO. And the company is really set up to benefit from this long term. We've built, like I said before, the marketplace is kind of our core business, where we've got 100,000 plus customers on there. But we're kind of really in a special space now where we can use the data that we have on our customers to benefit us to add additional revenue streams going forward. And I've mentioned before that we've started doing pet food subscription services now. So we're a big believer in the subscription service space. I think that's something that's been, coming out of COVID again, a couple of big winners out there, HelloFresh in the US or Marley Spoon here in Australia in the kind of human food space. But normally what happens is once something takes place for humans, the pet space kind of lags a little bit behind that. So I think within the next couple of years, we're going to see a huge surge in subscription services for pets. And that's definitely one of the parts that we're going to play in. The other part is obviously data. Data is for any business, I think these days is hugely important, but particularly in the pet space, we're very well positioned to kind of take advantage of that. Like I said, we don't only have 100,000 paying customers on this side. We've got over 500,000 people on our database. We've got nearly 1 million people coming to our sites now per month to get information about pets. And all that means we learn more about pet owners, what they want, what they need. And that's really what we want to use going forward to offer the right products and services to them. So really what we're building is an ecosystem here from pet services and pet products in subscription space, making sure that we're much more competitive than some of our competitors in this space, just tackling one part of that equation. We're really kind of building an ecosystem for pet owners to make pet ownership easier and make sure we present the right products and services at the right time.
Great. And I suppose for our last round of questions, it would be helpful to look at an outlook. And before we get to that outlook, I'll start with the fact that the ASX last year released an investor study saying that we have a record amount of millennial and female investors investing into the ASX, which also means a record amount of investors that require education. So really as accessing trading to public markets becomes more and readily available, we're seeing some new trends emerge with retail investor behaviour. And Ron, I know that you're active on Twitter. I'm keen to hear your thoughts in terms of what have you observed in terms of this influx of new investors, and perhaps are you advising people that have never invested before? And when it comes to momentum and value investing, what would be your guidance to someone looking at the ASX for the first time?
Yeah, sure. Look, there's definitely a new type of sort of behavior or trend that's been happening. There's essentially, since lockdown happened in March last year, sort of a new generation of investors have emerged. Again, that younger generation that, was locked up at home, was pretty bored, relatively cashed up, not spending money, going overseas or going out, receiving government handouts and so on. And, they're getting zero in the bank. Interest rates around the world in Australia have essentially gone to zero. You're getting nothing for your savings. And I guess it was also quite an opportune time in terms of sort of the markets tanking. So most of these sort of new investors that came on board, and there were, tens of thousands and millions of them around the world, kind of picked the bottom. So since then, they've all done really well. And we've seen that sort of social media sort of trend in investing emerge, the memes of the world and the Reddit forums trying to sort of get everyone together to buy a stock and take it higher. And I think a lot of these younger investors, they're also buying sort of brands that they can associate themselves with. They're recognizable and they actually use them every day. So, the Afterpays of the world, Zip Money, Tesla, even like, for example, Airtasker, which listed only a month or two ago. I was quite surprised at the way it sort of performed a few days after listing. And I had messages from friends that never invested in their life asking me, how do I open a brokerage account? I want to buy shares in Airtasker because I've used it. So it just shows that, we've seen this sort of a trend emerge. And, unfortunately, and now obviously we're seeing it in the cryptocurrency markets and not on the ASX, but in the crypto market. And that's, we're seeing that happen as well. And unfortunately, there's, some prominent figures out there like Elon Musk, who's adding more sort of fuel to this fire and encouraging kind of, inexperienced investors to do it. The problem is that, unfortunately, I think as John mentioned before, history does repeat itself, but it does repeat itself kind of differently. And I think, it's inevitable that most of these investors will get burnt and will probably lose money at some point. Definitely in the cryptocurrency market at some point. And I think in the ASX, we're already seeing it. Those stocks that did really well and everyone made a lot of money on, for example, the Afterpays of the world, they're all down 30, 40, 50% in some cases by now, as that sort of, there's a bit of a shift in momentum. So I think definitely new investors should be cautious, and they should definitely, whether, educate themselves on different forums, or I guess they just don't have the same maybe advantages that more experienced sort of professional investors, fund managers have, because we have that regular access to management teams. We spend sort of full time researching this. And I guess experience does count in this industry. And, for example, I've been investing for 18 years and, you've seen quite a few crashes and crises, and you sort of kind of learn how to deal with that. So, yeah, definitely I recommend investors be cautious and educate themselves as much as they can.
That's a very true and very good advice. That experience, certainly in this industry more than most, does count. And Robert, on that note, have you come across any new investors that you feel need some guidance or some lessons? And how would you recommend they avoid some of the risks that have arisen in the past year?
Very true. We're a wholesale fund, so we don't deal into the retail space. So my interactions in that world are limited to that extent. But what I would say by observation, and I concur with what Ron has said, as the old saying goes, when somebody with money meets somebody with experience, the person with experience will get the money and the person with the money will get the experience. And it's I truly hope that a lot of people who are going into the share market for the first time are doing so in a way which is progressive, which is gradual, and which is part of a broader education journey. Because it is very important that people take ownership of their financial futures, but you don't want to confuse luck and skill as being the same thing. And for that reason, I think it's important that people, if they are unsure, that they do seek professional advice from someone who's licensed to do so. And they spend a lot of time reading, understanding, and working out what their investment philosophy fundamentally is. Because that will be what guides them through market environments and various investment ideas, both now and into the future.
Absolutely. And John, your advice perhaps to new investors or anyone getting tempted by some quick returns?
Yeah, well, don't be fooled by your success. That's the first thing I'd say. And the second thing I'd say would be, spread your risk. I mean, don't put all your eggs in one basket. Don't go all out on momentum stocks. Don't go all for value stocks. Don't go all for dividend stocks. Just spread it around a bit, because when the markets crash, and they inevitably will in some way, shape or form, it may not be that across the board. It may be only tech stocks like it was in 2000, or it may be only other types of stocks that are in other times, Asian stocks, for example. And 1987, I mean, everything came apart, but the value stocks, the ones that had fundamentals, if I could call it that, rather than value, fundamentals, they came good pretty quickly. I saw something which I sent to my son the other day. I said, it's a company called StockX. It plans to kick off in Australia, and their business model is to sell second-hand designer sneakers like Nike Air that's been worn by some famous dude somewhere or other. And they've valued this business at $4.9 billion. And they're a second-hand sneaker dealer. I mean, seriously? I mean, I just get blown away by that sort of stuff. I can't countenance that. I mean, it just defies all logic. And when you defy logic, eventually logic will prevail. And eventually these values will come off. Like Ron said, eventually the cryptos and the Bitcoins and all those things will come crashing down. I don't know when. I'm not a soothsayer, so I can't tell you when. But inevitably, when something gets pumped up to such an extent, a bit like my bike tire, if I just keep pumping, eventually it bursts. So you've got to look at the meter and say, have I gone too far, So
yes,
I'm sorry to be a bit of an old, fuddy-duddy, but, that's life. There's no such thing as a free lunch. It's not a good one.
That's a very true line. And Justus, I know that you mentioned you've also invested and being an entrepreneur and seeing the current climate, having put your company through an IPO recently, what would be your advice or recommendations to people looking to start investing now or maybe even continue their investing journey post-COVID? What do you think that they should be wary of or perhaps looking for opportunities to?
I mean, I kind of agree with most of what the guys have said before. One of the things I certainly have learned is that you've got to be quite aware of kind of how much time you have to spend on something to become an expert in something. Particularly in momentum investment, which always sounds kind of very tempting to make a quick buck. This can be quite hard sometimes, and you've got to spend a bit more time on actually looking at those investments where value, and again, when you're using John's there, maybe looking at fundamentals and taking a long-term approach. Sometimes it might be the better thing to do if you don't have the time to follow stocks on a daily basis. And that's certainly something that I've learned along the way for me. I look at fundamentals of businesses, people that I really trust in terms of a long term. It's going to be a great business. And that's kind of what I invest in. And that takes a little bit more time at the beginning of the investment, but makes it much easier to let this stuff ride and believe in, if you have high conviction that you've done the right research at the beginning, to let those things ride out. And then, the things that John has mentioned, the ups and downs that will happen on the market, you can get through them much easier if you know that you've got a company that provides value in the long term. So, I think that's something that I've learned along the way, and taking a little bit of a longer time horizon in your investment scenarios makes those decisions a little bit easier.
Well, gentlemen, thank you so much for joining us today for Wholesale Investors Small Cap 2021 conference. It's been a pleasure to discuss the difference and value between momentum versus value investing. And I'm sure you've given our viewers lots of insights to consider on their investment journey.
Thank you.
Thanks.
Thank you for joining us for the Small Cap Virtual Investor Showcase. I want to say a big thank you to our keynote speakers and to our panelists who participated in this. And also I want to say congratulations to the CEOs that have been featured. What I love about this space is I know how hard each of these CEOs work to build their business. And when the spotlight comes on the small cap space, we can see incredible results in the share price for them. So today has been about placing the spotlight on these companies. We hope you go and do further research, go on and track further information, participate in the company's activities, and look forward to joining you for our next event shortly.